morning everyone, and welcome to Macquarie's 2023 operational briefing. Welcome to Philadelphia. We're very excited to see you all here, and it's great that we're almost full. So just a bit of housekeeping before we start. If you can turn your mobile phones off or turn them to silent, that would be great. We're going to run through all the presentations and then we'll have a Q&A session at the end. We're going to run through a couple of videos to start with, so a regional video and then a welcome from Shemara, and then Sean will get up and give you an overview of our presence here in the Americas. This is our 21st operational briefing and our first outside Australia, so a very exciting event for all of us. With that, I will ask the videos to start. Thank you all.
Macquarie has been innovating and investing across the globe for over a half century, and a large part of that success has come from the Americas region. We have a broad platform, some very deep specialist expertise, an empowering culture, and a proven track record over time, and we feel well positioned for the future.
In Commodities and Global Markets, we deliver innovative solutions to our clients across a diverse range of industries. Across three business lines: commodities, financial markets, and asset finance. We provide expertise in capital and financing, risk management, market access, and physical execution and logistics.
In our corporate advisory, capital markets, and principal investing businesses, we're helping our clients and partners realize new opportunities each and every day.
We provide merger and acquisition advice, raise funds in the capital markets, and invest our own balance sheet into diverse companies and projects. Our expertise spans sectors including infrastructure, consumer, gaming, software,
services, financial institutions, and healthcare.
Across our asset management business, we invest to deliver positive impact for everyone. Institutions, pension funds, governments, and individuals entrust us to manage their investments in both public and private markets. In turn, we invest responsibly to deliver long-term value for our clients and for the communities in which we operate.
We are actively engaged in several communities across the Americas. Looking after our business better is a result of looking after our people and their communities better. We embrace diversity as a strength and believe we excel at driving meaningful social impact.
And this is how we are innovating and investing for a better future in the Americas and making a positive impact for our clients and our communities.
Good morning, everyone, and thank you for making the journey, especially long for many of you, to find out more about Macquarie's growing business in the Americas. And I'm sorry that I'm unable to be with you due to other commitments, including joining our Australian Prime Minister's business delegation to India this week. However, you are in capable hands with our senior leadership of Alex, Ben, Michael, Nick, Sean, and their teams, who will explain how our three global businesses are positioned in this important region and the opportunities we see before us for further growth. Now, as we prepared for this week's presentations, I was struck again by how far the business has come since my time working in Macquarie in New York, establishing our asset management business between 2004 and 2008. And back then, like now, we had recognized that the US was the world's largest market for financial services. And for over 3 decades, we have been patiently building our capabilities here in a disciplined way in targeted areas. And one big step up was our acquisition of the Delaware business in 2009, which now forms the core part of our MAM Public Investments business and is headquartered right there in Philadelphia. It was an acquisition that recognized the size of the US market and the need for scale there to have meaningful impact globally. And all of our businesses in the Americas have seen strong organic growth accelerated by strategic acquisitions like this when the right fit arose, such as the teams who came together to form the core of our CGM business, many of whom you will have the opportunity to meet on Thursday in Houston. When I arrived in New York almost 20 years ago, our 330 staff were around 6% of the global population. Since then, our Americas headcount has grown tenfold to represent now 17% of the total. And in our 2005 financial year, we delivered $538 million of income in the Americas, 8% of global income at that time, compared to over $8 billion or 48% of Macquarie Group's total income, as you've seen in FY22. Now, over the next 3 days, you'll hear stories of many diverse businesses collaborating within a consistent entrepreneurial culture, a culture in which our teams have been empowered to identify and deliver on opportunity in their local communities. Growing adjacently from areas of deep global expertise, we seek to address unmet long-term need in fundamental areas in the Americas, such as energy security and transition, population growth and the consequent demand for infrastructure, commodities and returns on saving, and the positive disruption of digitization. In focusing on these specialist areas, we believe we have created differentiated offerings that are of scale but remain small relative to the significant size of the US market and the opportunities they address. Despite the robust franchise we have built, each of which contributes the most meaningful share of their group's global income, we have plenty of runway for further growth. Consistent with our global model, we have developed enduring client relationships and a high proportion of predictable annuity-style income, while also building franchises that are positioned to benefit from the activity levels across a diverse range of markets. And this has allowed us to have more resilient earnings and growth compared to some other offshore participants who have entered the US market. Now, of course, these franchises are all about people. In this region, over 3,300 self-directed individuals working in diverse teams to innovate and invest alongside our clients and partners. And after the virtual years of the pandemic, I'm delighted that you have the opportunity to meet many of our teams in person. So tomorrow in New York, you'll be the first group to experience presentations at our future regional headquarters at 660 Fifth Avenue. That part of town is dear to me, as I worked in a much smaller space at the nearby Rockefeller Center almost 20 years ago, and have been back many times to work from our current building several blocks to the north. So I hope you find the week and the opportunity to spend time with the team informative and enjoyable, and I hope you discover aspects of our business that you weren't aware of. And I'm looking forward to seeing many of you in person around our full year results in early May.
Good morning. It's good to see everyone here in the room today. I'd like to add my welcome to Sam and also Shamara's. It's great to see some familiar faces here and a lot of new faces. Many of you took long flights to get here, and we really do appreciate it for joining us. It's an absolute pleasure and honor, really, to have you all here for our first ever investor roadshow outside of Australia. For those who have traveled from Australia, I really do have sympathy. I actually just returned from a visit to our Sydney office on Friday night, so I know the pain you're feeling if you just landed last night or had delays. I also had delays coming through Dallas. Holding this tour in the Americas for the first time really speaks to the significance of our business here. We have built it over many years, as Shamara was talking about, and I think the opportunity we have over the next 3 days is for you to meet with the teams on the ground who are actually driving our business here in the region. I'm particularly proud to welcome you here to Philadelphia. Hopefully you had a chance to look out the window or when you're walking over from the hotel, see that this is the global headquarters for our public investments business within MAM. And we're very proud of this location and how our business from Macquarie Asset Management has grown over time. More notably, of course, Philadelphia is really the historic significance of the founding of our country. It's what we call America's front lawn right here that goes from Independence Hall all the way down to the Constitution Center. And this is where, that building right there, that if you were staying in the hotel across the street, is where our forefathers actually walked in the front door and signed the Declaration of Independence to actually form this country. And when you look down at the coffee break, you can see the Liberty Bell. Philly, as we actually call it here in Philadelphia, is also the home, of course, you probably know even better than Independence Hall, to Rocky, the underdog fighter who worked very, very hard to become a champion over time. And if you were really ambitious this morning, you could run the 2 miles down the street to the Rocky Steps. We're both proud and inspired about our growing presence here in Philadelphia as a key hub in our region, and of course, the region more broadly. Let's start here with the market opportunity. Here in the largest economy in the world, as well known, in the largest capital market, it's also home to over half of the investable assets in the world. We are seeing very strong tailwinds from the industry trends that are continuing to emerge. And over the last 2 years, we've seen supportive government policies in the U.S. that are supporting this, particularly around infrastructure, of course, and the energy transition. More broadly, when we think about the Americas region, as you see here on the slide, it also includes Canada and Latin America, which also provide massive opportunities in our energy areas, the commodities areas, and also with infrastructure. These broad thematic opportunities are aligned very much with how you have seen us build out our business both here in the region and globally over the last many years. And clearly, over the last 30 years, we've been able to establish ourselves in differentiated positions within the 3 main businesses that we're in. So with this large opportunity, have we delivered financially over the long term here in the Americas? I think this is starting to look like Rocky. Some hard work is starting to pay off. As you can see, we've come a long way in the last 20 years. And the Americas' contribution has grown in both absolute terms as well as a proportion of the overall group's earnings. This is particularly true in recent years, as you can see here, and reflected in our recent strong performance for the first half of 2023. And you're going to be hearing a lot more about this from Ben and the team today on MAM, from Silvo and Mike Silverton, the team on MacCap, and from Nick O'Kane, who is also here today on CGM in Houston on Thursday. We have a snapshot of the business. Shamar was speaking about how our business has grown tenfold in terms of number of people since she was here 20 years ago. We now have 3,300 staff, and while it's only 17% of our global population, you can just think about the contribution per person is very significant. Also, I think what's interesting is that the 3,300 people, 40% have joined over the last 4 years. Doesn't mean we have ins and outs, but also the expansion of our business, continued hiring in our businesses, the continued building out of our various capabilities has led to a much larger workforce here in the region than we had before. We have over 25 locations in the U.S., Canada, and LATAM that you can see here on the map to really stay close to our clients. That's the most important thing, and close to where the business action is. 5 have been opened since the pandemic began, while many other cities have been established for a long time. Of course, New York being our first, and Shamara being one of the early employees there. But as another example, Macquarie has had a presence in Brazil for the last 13 years, since 2010, and that business continues to grow there. So we have some well-established businesses in key markets. What's important, in addition to having all these offices, is to make sure that we're keeping our staff well connected between the offices and ensuring we have a consistency of the Macquarie culture. The Macquarie culture that comes from Australia is very much alive here in the Americas region, and we want to make sure our offices stay close together. You'll be hearing more about that when you hear the business presentations from MAM, CGM, and MacCap. Our presence reflects both the scale and the scope of our platform. If you think about Philadelphia here and also in New York, we're a top asset management name in both public and private markets. In Houston, of course, We've established a global energy hub. We also have a sizable presence in Calgary and Minneapolis. In Chicago, Los Angeles, and San Francisco, we're leading on advisory and educational technology, gaming, and also leisure. A very broad footprint that we're holding together. And this is what is, I think, unique about the region, just in terms of how broad our presence is here in the region, rather than being focused on only one or two offices. Over 30 years, you've seen continued growth and innovation. You've seen these slides before when we've looked at it from a divisional standpoint or a regional standpoint. And I actually shared this slide at the 2019 ops briefing that we had in Sydney, which showed how our growth continues, and it continues today. We're positioned our businesses for what we think are generational opportunities with a clear strategic action. From Macquarie Asset Management, you see the two at the top. After acquiring Delaware Investments in 2010, we have now made two other acquisitions, the Waddell & Reed acquisition and then the Central Park Group acquisition at the top of this chart. For Commodities and Global Markets, we expanded our energy capabilities over time. Of course, you're all very familiar with the Constellation Energy deal many years ago that Nick led. And more recently, we've added to that with Cargill's power and gas and also petroleum businesses. And in Macquarie Capital, we are continuing to build out our principal financing and advisory businesses to really make us a differentiated strategic advisor in the areas where we can really add value for clients and differentiate ourselves from the bulge bracket firms. And we're committed to continuing to build out our capabilities and continuing the story of continuing to add and expand out our relationships with clients and the capabilities that we can offer them. Also at the operational briefing a few years ago, I shared the regional thematic opportunities that we were seeing over the medium to long term for our business. And what I'd say is that these three themes are even more important now than ever. In the capital markets, you'll be hearing about the successes from our raising third-party capital and growing our financial portfolio. The changing energy landscape just keeps changing more every day. And you'll see our continued success in energy trading, renewable energy projects, wind and solar farms, and also renewable natural gas. And then, of course, infrastructure and real estate opportunities. You'll hear about our diverse portfolio, both on the MAM side and MacCap side, and exciting MacCap's leading role in the landmark P3 project, a bridge rebuilding project here in Pennsylvania. We've had a couple problems with a couple bridges Pennsylvania has over time, not Macquarie. We're helping to fix them. Oh, sorry. So how are we executing on the opportunities that are ahead? I think there are three key attributes which has led to our success and will continue to lead to our success. First and foremost, it's about our people. They're our most valuable asset. We continue to focus on attracting and really empowering our talent. I think that's what makes Macquarie different. And really focusing on specialty expertise. You're going to be hearing about this a lot today from David and others about the expertise we have in various areas of the marketplace. But this is what I think distinguishes us here in the region. The second is, of course, our operations. We have continued to grow significantly in terms of business volumes in all aspects of our business. And our central services group here in the region are continuing to support that operation. And I think most importantly, protect that growth, manage the risks. It's critical to our business. And lastly, we care a lot about our communities. And this point is uniquely important to our business and our people, and thinking about our infrastructure business in particular around the country. This is a clear differentiator for us in the region, and we're proud to have a very sustainable impact on the region and the communities within it. We continue to deliver in the region, and I think take advantage of all the opportunities that I've spoken about this morning. And I think this is really how we are trying to innovate and invest for a better future here in the Americas. So I'd really like to welcome you here today again, and thank you for coming and making the long trip. If you had to make a long trip here, I know one or two came down just from New York. But really enjoy the 3 days ahead. Please ask questions during the break. We're here to really help and to give you as much insight as we can about the company. So I hope you really enjoy the next 3 days. Next, we're going to have a short video giving an introduction to Macquarie Asset Management, and then Ben Way, our global head of asset management, will come up and start our next session. Thank you.
Macquarie Asset Management is a different type of place to work in the region because it's such a flat structure, and we're all kind of treated equal, and that makes Macquarie Asset Management so different than other firms in the industry.
We are an open, welcoming environment where everyone can really bring their whole true self to the table and bring a diversity of ideas and opportunities that ultimately helps make our investments better.
It is not about individual success. It is about a team success. And also it's about making sure we are fulfilling our fiduciary duty for our clients.
The client really is the center of which all of our business revolves around. You know, we want to know what their needs are, what their goals are, and how we can help best achieve them. You know, a lot of the money that we manage is tied to people's retirement, and we take that very seriously as fiduciaries.
That we have, you know, very high quality strategies on both the alternative side of the house as well as in the traditional asset management side. On the alternatives, I think, you know, we're a leader in infrastructure, and also on the traditional side, we've got, again, high quality and very good teams and strategies in global equities, global fixed income, and multi-asset strategies.
We're not trying to deliver everything to everyone, but instead focusing on the areas where we have deep relationships, deep knowledge, and delivering that expertise in our products that we're bringing to our investors.
What sets MAM apart in the Americas, I think it's just the structure of the organization is unique. So what Macquarie has been doing is building this awesome powerhouse umbrella over the boutique structure. So we can draw resources from the Macquarie Group. It has a powerful global brand associated with it.
Some of the things I'm really excited about is as we move into the democratization of finance, and we really come up with some alternative products for access to high net worth individuals and retail investors that haven't had access to these products in the past. We're opening up doors for a whole new clientele in the retail market.
We are very excited about climate solutions. As a firm, we're deeply committed to providing climate solutions to our clients, and we're committed to the energy transition.
We are creating the next generation of assets that will help move the world towards a zero carbon economy.
A critical component of our stakeholder mapping are the local communities where we operate. Our assets every day are used by millions of people globally, but no one is affected more than the local communities where we operate.
There are different ways in which you can actually change the world, but I think allocating the capital and having the ability to allocate significant amounts of capital can actually make a big difference.
Good morning, everyone. A very warm welcome to you all. As Sean conveyed, we really appreciate you being here with us today. And we also appreciate the people watching the replay, which Alex and I are informed also includes Shamara, so she's always present. As you probably saw through the videos, you know, we have a really, I suppose, dynamic culture across the firm. It doesn't matter which video you watch about which group, in which region, you'll see that you know, everyone here is high performance and they're passionate about what they do. We really love what we do. Now, unlike everyone else you're going to hear from today, I have not been in the Americas for a long time. I've actually only been a resident here for 6 weeks. And so the question I get a lot when I was moving here, and which some of us were already discussing today, is why have I moved here after 23 years in Asia, including 16 for Macquarie? And it really accords with what we've heard in the videos today. This is our biggest market from an asset management point of view, but it's also our biggest opportunity. So it just frankly makes sense to be here. And equally as leaders, as a leadership team, we don't think we can ask our teams to do new things and then not do new things ourselves. And so it's really great to be here. One thing that I didn't think I'd be saying in Philly is that, I'm now a proud Knicks, Mets, Rangers and Jets fan. That's not something you would normally mention, New York teams in Philly, but I feel proud to have embraced the city. And perhaps most excitingly, my kids live here. And so while they're both on the West Coast, it's great to be here and be a more present dad. As they say to me all the time, you're close, but not too close, which is true. It is very true. So if we turn to our global platform, today we're managing $800 billion of AUM on behalf of more than 1,000 clients. And while our purpose and vision as an asset manager remains the same as the last operational briefing, as you can see, our platform continues to evolve and grow, whether it be through the launch of new strategies in terms of private credit and real assets, the integration of the Green Investment Group, or even the acquisitions of Waddell & Reed and the Central Park Group. We've also been adding leadership capacity to our business. So over the last year, we've appointed Peter Glazer as the head of private credit and asset finance, and we've also appointed Christina Kloberdance as the head of sustainability. And one thing I think is really important to note here or recognize is that our clients, which are pension and superannuation funds, which are insurance companies, which are wealth managers, family offices, and also state and national sovereign wealth funds, represent hundreds of millions of underlying clients. And these clients rely on us every day. They rely on us to have a dignified and secure retirement. When they want to draw on their insurance policies, they're relying on us to deliver for them, to make sure that those insurance policies can be funded. And in some cases, they're relying on us to help develop and transition their communities. And so what our teams recognize, what they understand, is that this is a very important job. And so we really appreciate the privilege, but also the responsibility that comes with being our client's asset manager. This is something we talk about in MAM all the time. And if you think about our business model, the business model of MAM is incredibly simple. We are trusted by clients to match their capital with opportunities with the aim of growing their assets. And this fiduciary duty informs everything we do. Our clients' interests are at the forefront of every decision we make, because ultimately, trust and confidence between a client and a manager from a fiduciary point of view comes really down to one thing, and that is track record. Our clients have to know, they have to trust that we will deliver on what we say we're going to deliver on. And so when you think about what are the sorts of teams that we're fostering, what is the sort of culture we want, well, it's really twofold. One, we want to have teams that are deeply expert, that are experienced, that are continuous, and that are present. And so if you have a look at it here, you can see that the average tenure of our executive directors is 15 years. Secondly, we want teams who are able to be a reflection of the communities in which they operate, so that they are authentic and they do understand both the opportunities and the culture in which we're asking them to make investment decisions on behalf of clients. And so we celebrate the fact that we have 114 cultural identities across MAM and that many of our team are bilingual. So as we've heard from the videos today and from Sean's comments earlier, the Americas is our largest region in terms of people and assets under management. Today we're managing more than $350 billion of AUM. We're investing actively in 5 different markets or geographies, and we've got teams based in 16 different locations. Something that's very particular to the US, unlike any of our other regions, is that 47% of our AUM comes from wholesale clients. And that's something we'll talk about later on, both in terms of Andrea's presentation and Sean's. Now, importantly, our platform is in a very good position to grow because we continue to deliver superior investment performance. This is ultimately what our clients rank us on and rate us on. And so if you look, for example, at our recent America's infrastructure funds, you can see that we're delivering a 17+ return since inception. Across the private markets business globally, we've got a record level of dry powder, given historically high fundraising levels, which goes to the relationship that we've been building and deepening with clients. And some of that 3.3 billion dry powder here in the Americas. And if you look at, say, public investments, 77% of our investment strategies are outperforming the 3-year benchmark. So why is this important? Well, as we, like all asset managers, move beyond the easy money era, the distinction between what is a good manager and what is a great manager will become much, much clearer. And that the real differentiator from our perspective will be the ability of investment teams to drive great investment performance right across cycles. And that comes down to culture, it comes down to experience, it comes down to expertise, it comes down to character. And it's these facts that ultimately will differentiate teams who are able to deliver returns versus superior returns. And so something that we really want to talk about today and convey to you is that we think we're in a good position based on this track record and the foundations we've been putting in place for over 20 years in the asset management business to continue to do that on behalf of clients. It's also, I suppose, important for us to acknowledge that the outlook for asset management remains very positive, with the Americas the most important market in terms of both size but also growth. You know, as this slide demonstrates, the Americas represents a $56 trillion opportunity, and it remains significantly underpenetrated, that set of assets, from a private markets or alternates perspective. And so from a MAM perspective, what that really means is that there is a lot ahead of us, and we're in many ways only just getting started. When you think then of the key investment thematics here in the US, they align with our expertise and focus, whether it be digitalization, whether it be energy transition, or also the diversification of retail investor portfolios from the public into the private markets. The other thing that I think is important here to talk about is product diversity. Having entered an inflationary environment where clearly we've got rising interest rates, we've got higher market volatility, having an array of investment capabilities is important because that allows us to respond and work with clients to their different needs and preferences, which are changing. As you can see here in the Americas, our platform continues to evolve, much like the Americas itself. Our industry, our region is incredibly dynamic, and so it's important and critical that we keep identifying new opportunities to realize. What worked 5 or 10 years ago doesn't necessarily work today and won't necessarily work in the future. And so that's why having a culture of innovation is so important. If you look at just some of, say, the select highlights over the last 12 months, you can get a sense of how we use deep sector expertise, but also networks we've built out, local networks we've built out over many years to help identify opportunities and then move into adjacent sectors or markets. The other thing that I think it does explain also, not just for MAM, but for the broader Macquarie business, is how we've been so resilient in the US and been able to build such a big platform over the last 20 years. Now, the thing for us as an asset manager is that we need to get the balance and the cadence right between making sure that we're investing and extending in our core businesses, our existing businesses, but also moving into new areas. And that all comes down to teams that prioritize. And this is something that we're getting much better at. If you look at, say, the examples of, say, CLI, a ports operator in Brazil, Inspiration Mobility, which is something we'll hear a little bit more about later on, which is our energy transition business based in DC, or even how we've exited some of the closed-end funds in our public investments business, you can see how we are constantly calibrating the opportunities that exist in the different sectors and markets in which we operate, and most importantly, making decisions about what makes sense for clients and the capital we allocate at any given time. So in terms of growth, what you can see here is really the importance of the Americas. From a MAM perspective, the region continues to step up, whether it be in terms of AUM or operating income. If you pause just for a second and think about both, say, the market opportunity slide, and then you have a look at this, what you can see is that, yes, we've built a scale business relative to the rest of MAM, but also relative to other competitors. But what exists here is a very significant opportunity to continue to grow our business, whether it be, say, in credit, where we're seeing good inflows in both fixed and private, in real assets, penetrating new client channels, or even entering adjacent geographical markets. Now, in terms of going about seizing that opportunity and making sure that we can continue to deliver, we have a clear strategy for the Americas that builds itself off the global MAM strategy. As you heard, MAM does not try to be all things to all people. We're not copying what other people do. We're not going for scale for the sake of scale. What we try and do is really focus on areas where we believe, on behalf of clients, we can deliver differentiated and superior performance. So if you look, for example, at, say, real assets, which is one of our core businesses, it's about building on our leadership position especially say in sectors like energy transition, where with the integration of GIG, we can now operate up and down the risk spectrum. And given clients' demand for these sorts of opportunities, that's clearly a very exciting opportunity where we keep doing what we're going to do, but we do it in new sectors and we do it in bigger ways than we ever have before. If you look at, say, some of our other alternate areas, such as real estate and private credit, that's really about backing teams that have expertise, who have great track records, allowing them to build scale and making sure they've got the right distribution. And that's what it's allowing us to move into, say, opportunistic real estate strategies, or into things like infrastructure secondaries that Wendy will talk about later this morning. And then in terms of public investments, what we've been doing there is continuing to scale our platform through acquisitions, but also investing in technology so we get real operating leverage. And what that's allowing us to do is to take businesses with a very long heritage, some of them, almost 100 years old, and position them for different client channels, but also allowing them to continue to deliver strong performance. And lastly, we're ensuring our investments are fit for purpose for the world we find ourselves in. So from our point of view, sustainability and net zero is foundational to what we do. And so right across our portfolios, we're making sure that we embrace sustainability, that we drive towards net zero targets, because ultimately we believe the best investments with the best terminal value will actually be sustainable investments. And so if you think about, well, how is that translating into performance? Do we have momentum? I think what these two charts show is that that's clearly the case. So if you start with, say, the private markets platform, we are raising and deploying bigger funds than ever before and raising each new vintage more quickly. So what this goes to is the appetite of our clients, but in particular, the partnership we have with clients as we deepen those partnerships through great client experience, but also through performance. Equally, if you look at the public investments chart, what you can see is that our AUM is consistently stepping up, and what's really pleasing about that is we've got increased operating leverage. So as I mentioned earlier, sustainability is foundational to what we do. We believe it's critical to our license to operate and being a responsible asset manager. We were the first global asset manager to come out with a hard net zero target, and we committed to doing it by 2040 across our portfolio, not 2050. We're actually making really good progress right across our portfolio of 180 companies. And here in the Americas, 100% of our real assets portfolio are executing detailed net zero plans. And importantly, I think it's key for us to note that this is actually resonating with all our stakeholders, with clients, with regulators, and also our own teams. Now, none of this is easy, to be honest, and it really does take real leadership. But as you can see, this is not something that we've come to lately. We've been doing this for more than a decade, and we really believe passionately that it's important that people like ourselves play a leadership role in net zero and help drive a smart but orderly and just transition. I think the other thing that's important to note is that sustainability is much more than just net zero. So it's also about things like protecting and enhancing biodiversity, and you'll hear a little bit more about that when you do the asset tour tomorrow at MAR Terminals. It's also about thinking about the impact we can have in our broader communities as an asset owner. It's about social mobility and economic inclusion, like the intern and permanent employee programs we have in Mexico. It's also about driving world-class governance standards, which is something that we are very focused on and very proud, and making sure that those governance standards are built around things like equity, diversity, and inclusion. Finally, I just wanted to highlight we wanted to highlight the importance of risk management. At the end of the day, all great businesses are safe businesses. Our best defense in an increasingly complex world will always be having a very strong risk culture, a culture where the business owns the risk, where the business risk is never outsourced, where everyone feels safe and empowered to speak up, where everyone feels accountable. And this extends not just to our own platform as a fiduciary, but also to our portfolio companies, where we're driving risk standards and policies because we believe that it not only creates value, but also is the right thing to do. And I think, a really good example of this is Solvi, which is a Brazilian-based waste management business that services more than 10 million people. Our team's worked with the Solvi management team since 2019 to draw on global work health and safety best practices, and also to leverage our internal experts to really drive and enhance the approach at Solvi. And to Tate, as you can see, that's had a real impact. So what we've seen is that, an 88% reduction in the lost time injury frequency rate between 2019 and the end of last year. And so you might ask yourself, well, why is that important? Well, that's important because that means our business, Solvi, can better service its clients. It means that it's a better place where people can work, and that means that we can attract better talent, but it also allows us to drive the bottom line. And so I think this is a great example of why risk management for us is not just a tool, it's also a strength and something that we invest in and build upon. So before I hand over to my colleagues, maybe I'll just make a few summary comments. I think, what we really want to share with you today, not just obviously in these presentations, but in the conversations that we have more informally and during Q&A, is that we are really excited about the opportunities ahead for MAM in the Americas. Over the last 20 years, we've built a scale resilient platform, but what's clear to us, and hopefully is clear to you, is that there is very significant growth opportunities ahead of us. As you'll hear from all of my colleagues this morning, these opportunities exist in terms of broadening our partnerships with clients and deepening those relationships, about expanding our distribution capabilities, about launching new strategies in terms of new sectors and markets, but also about continuing to scale through selective acquisitions. Most importantly, what is critical for you to know is that our teams are focused on their responsibilities every day, which is about delivering for clients and making sure that they invest to have a positive impact for everyone. So with that, let me now pass over to Andrea to talk more in depth about the Americas capital opportunity, and thanks everyone.
Thanks, Ben. Welcome everyone to Philadelphia, and I always love coming down to this office. I spent my university years here in Philadelphia, and it never fails to inspire me to see Independence Hall and Liberty Bell. So as an American, please spend 2 seconds and enjoy it before you leave and head back to New York today. So I'm Andrea Modi. I'm part of our Client Solutions Group, and that is the group that, as its name implies, gets to interface with our clients here in the Americas and around the world. I have been with Macquarie for 16 years. I have been based in the New York office during all that time. So I left Philadelphia, came to New York. And most of that time I have spent working with our institutional clients. And over the last few years, I have turned my focus more to work with our wholesale clients. And I'll talk a little bit about that. But I feel really privileged to be able to connect our investors with the great investment expertise and the opportunities that we see. And particularly when it comes to things like, helping them on their own journeys to net zero. So we're obviously helping the world go on that journey, but we're helping our clients do that as well. So you've heard from Sean, you've heard from Ben, you're going to hear from everyone today around the size of the market here in the Americas. This is, on the institutional side alone, a $22 trillion market. When you start to get to the trillions, I don't know about you, but those are big numbers. But that's half of the global institutional asset base. And in the Americas, that's made up of 10,000 public, corporate, and union pension plans, insurance companies, and probably a little bit more unique to the Americas, foundations and endowments. So a very big market in terms of size and in terms of number of investors. And how are these investors different? In some ways, they're no different from global investors who you all are familiar with. They do tend to have a higher risk appetite, and they are typically seeking higher return strategies. They also tend to use advice. Over 85% of the institutional investors in the Americas use investment consultants. And one thing that's sort of interesting as well is that you see here, because of their slightly higher risk appetite, they have a higher allocation to private markets. So around a 20% allocation relative to the rest of the world at about 5%. And within that bucket, a relatively smaller allocation to things that we do particularly well, like infrastructure. So we do continue, the investor base globally, and in the Americas is no different, is somewhat cautious for good reason today. But we continue to see good demand for things like infrastructure, its defensive characteristics, and its inflation protection. And increasingly, things that we're doing in the energy transition space, we're seeing a lot of curiosity around those opportunities as well. So, I think as everyone is saying, big market, definitely still plenty of room for growth. Now on the wholesale side of the market, so you're going to hear this term wholesale. What is this? This is the part of the retail market, so the individual investor market, that is intermediated by wealth platforms who typically have very large financial advisor bases. And this is an even larger market in the Americas, $34 trillion in assets. So we're seeing really strong growth in assets from this market. And there is a segment within this that we're calling the mass affluent. And those are investors with assets of 1 to 5 million in net worth. That is growing particularly fast. We're also seeing pretty strong growth out of the even wealthier high net worth investors that are 5 million in net worth and above. So one opportunity that I'd like to highlight for you today is the shift that we're seeing in allocations amongst these wealthier investors. And that's really sort of, these portfolios are really evolving away from that traditional 60-40 portfolio. And, both the investors themselves, but also their advisors are increasingly looking to add alternatives to their portfolios to add a source of diversification away from the public markets. But also to find new sources of growth and income, and sometimes both of those things. So that mass affluent segment then within that has historically really been underserved in terms of accessing alternative investments. So today we find that they often have zero or very low allocations to alternatives. So they're starting from a very low base. And we expect that these portfolios are going to look quite different in a decade. So what's happening in the market? We're seeing a huge amount of innovation in terms of product structure, in terms of features that are for individuals rather than for institutions, and a lot of education happening in the market to really help individuals and financial advisors understand the risks and rewards of using alternatives in their portfolios. And by the way, this is not just a US phenomenon. This is happening everywhere around the world. So we think that this is a great opportunity for MAM, given the capabilities we have, obviously, on the private market side. And also we have significant distribution capabilities given our public investments business here in the Americas. And we strengthened our own capabilities in that mass affluent segment over the last year with that acquisition of Central Park Group, who brought a lot of innovation in that particular part of the market. In terms of capital raising, how are we doing here in the Americas and where do we want to be? Today we manage over 350 billion Aussie, and that's 44% of our global AUM. And roughly half of that comes from our institutional investor base and half from the wholesale investor base. So again, ample room to grow given the size of this market. And we do have really good momentum from a capital raising perspective. And over the past 6 years, we've been able to double the amount of capital that we're raising for strategies based here in the Americas. And we're looking to continue to lift the contribution of our global capital raising from the Americas from today's level that sits at around 20%. So where are we focused going forward? First, as Ben said, we're looking to deepen and broaden our relationships with our existing investors. And those are about 300 institutional investors in the Americas. And so that's about that long-term partnership mindset and really bringing them solutions today and not just products. And we're looking to take advantage of that scale that we now have in our public investments and business and do more with each of our existing clients across the breadth of MAM. And on the other side, we're looking to grow our investor base. So we're expanding our relationships with those really important advice-giving investment consultants because they're really critical gatekeepers here. And we're targeting the very large middle market, which is those thousands of plans sort of in the middle. And to do that, we're continuing to deepen our relationships with the top 25 US public pension plans who represent over $3 trillion alone in assets. And they really serve as bellwethers to the rest of the market, so they're really critical. So there is a lot going on. But let me share a couple of examples with you to bring this to life. And I think these are a couple of really great examples because they show how we're collaborating with clients. We're not just selling them products, we're really working with them. So the first one is a very large US public pension fund. It's a top 10 plan, and shockingly. They had never invested before with MAM. But we knew them, and they knew us. And in fact, we had a lot of touch points across both MAM and Macquarie Group. And we sort of internally came together to connect all of the dots and to understand all the various conversations we were having with this plan. And we were able to really speak to them with one voice and be coordinated and joined up on our side. And what we did is we went in and listened. What were they looking for? And obviously they're looking for a great investment product and excellent performance and differentiated deal flow, yes. But they were really also looking for other things. They were looking for us to serve as a resource, or they were looking for their managers to serve as a resource to their teams when their teams are doing particular transactions, to understand what our experts thought about those transactions. They were also looking to educate their own teams, junior folks coming through the ranks, learning how to invest these portfolios. They wanted exposure to our teams to help those folks get up to speed. So after a couple years of doing this, I'm really happy to report that this has resulted in an actual partnership with this plan. And so yes, they're getting the great investment products, and they're supporting our new strategies, including in some new areas. And we're also continuing, I think most importantly, to serve as a resource to them and to their teams. And there are a number of similar stories like this in our public pension fund effort. So I think it just gives you a good sense of kind of the momentum that we're having with those investors. So I spoke earlier about the expansion of alternatives within that wholesale market, and I'll share another example. And this comes from our acquisition last year of Central Park Group. This was with one of our partners who's one of the largest wealth platforms here in the Americas, and we already had a great relationship with them on the public investment side. And what they did, what they were concerned about from a strategic perspective was their advisors, only a small percentage of their financial advisors were using alternatives in client portfolios. And they really wanted to grow this. And so we went away and thought about this, and we sort of came up with a range of products for that mass affluent segment that really made it easier for advisors to adopt them. So we did things like lowering the minimums, simplifying the tax reporting, and importantly for this mass affluent segment, providing periodic liquidity, which is something alternatives typically don't do. So really just making them a lot easier for our wealthy clients to use. And this for us resulted in a record closing of our latest vintage product with them, which is a private equity and private credit strategy. But more importantly for the client is that over a series of years, it's been more than 5 years, they've been able to systematically grow the number of advisors in their base that are using alternatives with their client portfolios. So I'm personally incredibly excited by this opportunity. This is something I'm spending a huge amount of my time on, and I think we're just very well positioned given our strength in private markets and in the wholesale space here in the Americas. And speaking of private markets, with that, I will hand it over to David and the private markets team.
Good morning, all. Thanks, Andrea. Fantastic presentation. It's really, really nice to see so many familiar faces here. Just as I look out, I see people that I've had the opportunity to meet in London and here in New York in the last couple of years. For those of you that don't know, I'm David Fass, and I head up the private markets businesses here in the Americas region. I've been at Macquarie for about 12 years, 8 of those as the regional chief executive based in London, and the last 4 heading up the private markets businesses here in New York. Actually, not here in New York, in New York. One of the things that I want to bring a little bit to life before I kind of get started that really has had a big impact on me and I think is really important for our team here in the Americas. Ben mentioned sort of the fiduciary responsibility that we have in managing money for folks that are out there operating in the real world. And when we're out visiting with clients all across America, whether you're at a union hall, whether you're visiting an insurance company, whether you're visiting a pension plan, it's quite often when you're waiting in the lobby that you actually are confronted or you have the opportunity to sort of bump into those plan holders or those retirees. And especially when I'm traveling with some of our younger people, when they begin to connect the dots about sort of what we're really doing and what responsibilities we have to ensure the retirement, the healthcare future, and the educational future of those families is something that we really do feel a big responsibility and frankly is a big motivator for all of us, but I've noticed that particularly with some of our younger people on the team. As a few colleagues have mentioned already, we've been investing here in the private markets for the last 20 years. And as the slide notes here, we have 226, in fact, 226 people that are really focused on deploying capital across these private markets. Our teams, as you saw in some of the videos, really do represent the communities in which we operate. And something that I did want to pause on this number for a little bit, because 220 investment professionals sort of doesn't necessarily mean something in absentia. This is a group of people that is a very, very unique combination of skill sets. We have lots of people who went to fancy schools and are accountants or are finance professionals. We have a big set of legal colleagues. We have a good, solid set of tax colleagues, et cetera. But one of the real differentiators for us is that we have recognized that we don't know everything and that we can make better investment decisions and deliver superior, good, risk-adjusted outcomes for our clients if we marry together that financial acumen with real-world expertise. And so when you're traveling around over the next couple of days, please feel free to talk to some of our colleagues about kind of what they came from and what their backgrounds are. Just a couple of examples to sort of bring this to life. When we started recognizing what was happening in the energy transition world and recognizing that battery and battery storage was going to be a really key part of the future, we hired a few recruiters and we went to Tesla, and that's where we got our battery expertise. We hired a team of battery engineers from Tesla to help us understand what energy transition was going to mean for batteries. When we got into the waste and environmental services business, that business is now led by somebody who is the chief executive officer of one of Suez's major subsidiaries. So we actually have a very senior person who worked in the real world helping us make good decisions around that business. On our transportation team, we've got folks that worked in port logistics. We've got folks who used to actually work in the shipping lines, and we really understand what's involved in managing port and port assets. So those are the folks that we have that are driving the change that we're making and driving our clients to have an appreciation for how Macquarie is different. The private markets business consists of three pillars. Real assets, which is the infrastructure and green investing teams that you'll hear from today, real estate, and private credit and asset finance. We're going to focus today primarily on the real assets business, and I'm glad I'll introduce a couple of my colleagues to you at the end of my presentation. I also want to pause and talk about how important our clients are to our business and how we've been dealing with them. You've heard both from Ben and Andrea how critical the client franchise is to the success of our business. We're managing money for over 300 clients in the region, and since 2010, I think as you can see on the slide, we've raised nearly $75 billion from America's clients, and that percentage is growing day by day. But when we talk about our fiduciary responsibility to our clients, we also have a fiduciary responsibility to build these businesses so that they are successful for the hundreds of millions of people that are using them every day. And this is going to lead me a little bit to talk about the trust that we've developed with our clients. And that word trust is an incredibly important thing for all asset managers. But when you're given the responsibility to operate critical public services, it becomes even more important. And there are very few asset managers that have been given the privilege or the license to operate businesses like this. So a couple examples on this front. Today, we're the owner of two large-scale regulated utility businesses here in America, one in the state of Washington and one in the state of Louisiana. And for those of you that have a sense of the highly regulated nature of the U.S. or the litigious nature of the U.S. or how challenging it can be to deal with sometimes the U.S. consumer, to be able to navigate the Public Utility Commission in those two states, understand the union dynamics, understand what happens in the local neighborhoods when there's a storm or a power outage and sort of how we deal with that, is something that we've proven over time to the Public Utility Commissions around the country that we can be entrusted to do that. That's a very, very important thing that allows us to see unique opportunities that some of our competitors may not have the opportunity to do. In the transportation sector, my second example, we invest in infrastructure that's critical to supply chains, including roads, airports, seaports, rail networks, etc. Incidentally, we're the largest private operator of shipping terminals here in America. You'll see one of them tomorrow, both on the East Coast and on the West Coast in New York and in Los Angeles. We manage about 12 million container lifts per day. That will start to mean something to you when you get into it tomorrow. maybe that sounds complicated, maybe not, but in order to deal with the Longshoremen's Union, in order to deal with the local communities where there are trucks and noise and those types of things happening, we have to be very professional in the way that we go about servicing those businesses. From a federal regulatory perspective, we have to deal with the FBI, the Federal Bureau of Investigation. We have to deal with the U.S. State Department around security issues on what's coming and what's leaving the country. And that trust that I'm talking about extends all the way from the folks that are using the assets that we're managing all the way to the federal government that is monitoring and partnering with us on everything that we do. As each of my colleagues have mentioned earlier today, the market opportunity here is immense. As we consider the backdrop of the macro themes here in the Americas, I think that this is a generational moment that we're experiencing from an asset management perspective. And I just want to call out three things on this slide in particular. In the world of infrastructure, there has been somewhat of a lack of spending in this country on infrastructure assets, and so there is a long runway of opportunities that we'll have in the infrastructure and energy transition world. Many of you I chatted with over coffee have been here for a couple of days. Yes, the train hall in New York is nice, but the train system needs some work, the road system needs some work, the airports need some work, so the opportunities for investing here to make the country better are immense. In the world of energy transition, we think that the opportunity in the U.S. is massive. Think whatever adjective you want to put behind it. The Inflation Reduction Act, the Infrastructure and Job Act, the U.S. government has put nearly $500 billion of capital into the climate and energy funding transition that the country needs to go through. We think that that's going to operate as a real catalyst and a multiplier to allow us and other private investors an investment opportunity that I think will define a generation for years and years to come. On supply chain disruptions, COVID and the resulting supply chain challenges that we saw have made many companies recognize that they don't want to be overly dependent on one particular manufacturing region. And as a result, we're seeing lots of U.S. corporates shift their manufacturing facilities into America and into the northern part of Mexico that I'll talk about in just a second. As we consider all of these opportunities, as I mentioned a moment ago, this is a division that consists of three pillars. On the real estate side, we're managing about $13 billion across over 420 properties. Those are pretty evenly split between industrial, multifamily residential, and office buildings. One of the really interesting things down in Mexico, Ben and I were there on a trip just a couple of weeks ago. We have a publicly listed REIT down in Mexico. REIT is a real estate investment trust. For those of you that don't know what it is, in Mexico they're called FIBRAs. That business is the largest developer of industrial properties in the northern part of the country. And if you just think about the geography and what the whole nearshoring shift is going to mean over the next few years, we think that our Mexican business on the real estate side is going to be a real beneficiary of that. If we turn to private credit, many of you will know that business originated in the UK as a world leader in the world of infrastructure debt. We're now growing that business sort of here in the US. We raised about $500 million last year to invest across fiber and digital infrastructure assets off of that private credit platform. So that's a big area of growth for us going forward. The largest part of our business is the real assets business, just over $50 billion in assets under management across 30 industrial businesses and 9 green investments. The integration of GIG has gone incredibly smoothly. I'm very proud that you'll be hearing a little bit more about that business today. Not only is that GIG integration to MAM really helpful from a business expansion opportunity, but all of those 30 industrial companies that want to do a better job around sustainability, around climate change, now have sort of an in-house set of experts that sort of can help advise them on what they need to do with each of their individual businesses. And so you'll hear from Will about that in just a moment. So with that as an overview of the Real Assets platform, let me turn things over to Carl Koschel, who will give you a bit of a deeper dive into how things work in the infrastructure business. Over to you, Carl.
Thank you, David. Good morning, everyone. Welcome to Philly. So when we talk about the private markets platform, which David has outlined, we're going to take it sort of one step deeper, and Jenny and I will give you an overview of our infrastructure business, which is our largest and most well-established private markets business. So for those of you that don't know me, I'm Carl Cashel. I'm the head of infrastructure for the Americas for real assets. I've been with Macquarie for 20 years, so I'm bringing up the 15-year average that Ben mentioned earlier. But of those 20 years, I've been based in New York for 18 of those. And I've been part of this infrastructure team. So I've been really proud to be part of this team that's grown this business over that time. So as you know, Macquarie is the largest infrastructure manager globally. And the Americas has played, and the US in particular, has played a really important part of that platform over time. And so what that means is we have a long-established regional infrastructure series that many of you will know well. We're currently into our 7th vintage of that. And then the team here in the Americas also sources and executes opportunities on behalf of our global infrastructure strategies. So over the last 20 years that we've been investing in infrastructure in the Americas, we've clearly developed a long track record. I mean, you can see there on the slide over 50 individual portfolio company investments. But when we think about the track record, it goes well beyond sourcing. We've then managed these investments through all stages of the macroeconomic cycle, through phases of growth, phases of maturity, and then in many cases have exited those particular investments. So what's really important about this track record is not just sort of its longevity and the sourcing piece. It really comes through that full cycle experience. And that's really important for investors today, given where we are in the macroeconomic cycle. So it's important for investors to see that we have the experience to manage these assets through all stages of the cycle and create value for our clients at all stages of the cycle. So, that's really what I'd leave with you with the what of our business, beyond the size and the scale, is really this point about experience and expertise and a really deep realised track record. So this next slide, if the first slide was the what of our business, sort of all of the statistics, this is the how, how we go about our business. And clearly we're laser focused on maximising and delivering returns for our clients, but we really want to do that in a holistic way. So we're focused on our fiduciary obligations, but with that, in our holistic approach, we're looking at a focus on our full stakeholder set, and a number of my colleagues have already mentioned that, as well as diving into a number of areas around ESG, for example. So sustainability, DEI, cyber, and then health and safety. And Ben mentioned this earlier with the Solvay example, but across our entire portfolio, we've reduced our injury frequency rate by over 60%. So that means that everybody has the opportunity, has a much better opportunity to go home safe. And so we really view ourselves as a responsible owner and operator of these assets. David spoke earlier about our team, the expertise of our team, the structure of our teams, our investment professionals having a wide variety of backgrounds. And we actually have over 70 investment professionals in the Americas, primarily in the US, focused on managing our infrastructure investments. Now, that combination of track record, team, and reputation is critically important when we turn to sourcing. So I think the best way to highlight the point on sourcing is to give you a couple of examples. And so a couple of examples just from the last 12 months. So we recently acquired a 50% interest in a portfolio of port terminals. And so the terminals were owned 100% by a major shipping line. And so we're going to be a co-shareholder along with them. They're retaining the other 50%. But they were willing to engage with us on a bilateral basis because we'd actually known them for decades. We'd worked together previously and they trusted us as a partner. Another recent example in the waste sector, there was a small, fast-growing company. We'd just started to track that company. We hadn't engaged with them. And as it unfolded, they actually approached us and effectively said, look, we've seen what you've done with other waste businesses over the last 15 years. We've got a company that we think has a really good growth profile. We need the right partner, and we think you're the best partner for our business. And so today, we are the majority shareholder, and we're working alongside the management team to deliver on that investment case. So these are examples of how sourcing has really led us to have a leading position in infrastructure. And David mentioned that we're the largest port owner in the US, but it obviously goes well beyond that. In the waste sector, for example, if if you put together all of our waste sector portfolio companies, we actually have operations in almost 20 US states. And as you can see on the slide, we also have a very large sector franchise in digital infrastructure. So 23% of the capital that we've invested in the Americas over the last 20 years has gone into digital infrastructure. So now clearly digital infrastructure along with energy transition has, they're probably the two areas that have had the most client focus over the last 3 to 5 years. So our point here is not so much our expertise. Now we have deep expertise. We've invested in towers, data centers, fiber, carrier hotels. I think the real point here is that we made our first investment in 2007. So if you cast your mind back that far, we actually signed our first investment in digital before the first iPhone was released. So we've been doing this for a really long time. And then after we've sourced these investments, acquired them on behalf of our clients, that's the first phase. Then it's all about creating value for our clients during the holding period. When you actually look at that, our focus is an operational focus on driving EBITDA growth. And that focus on EBITDA growth means that the biggest value driver for our platform over that 20-year period, it's not market timing, multiple expansion, it's not capital structure, it's not leverage, it's EBITDA growth. And that's one of the key reasons that even as we've come through more difficult periods like the COVID period, we're still actually able to deliver really strong outcomes for our clients throughout that period. And I think just on the leverage point, we run about 35% leverage to value across our portfolio. So it's part of our capital structure, but we actually think about it more to provide liquidity for growth as opposed to any other reason. And when we return to this EBITDA growth point, there's this whole series of initiatives that we're looking to implement at these portfolio companies. It can be capital expenditure, capacity expansion, modernisation. You actually look across these our 56 portfolio companies. We've invested almost $30 billion in capital expenditure during our holding period across these portfolio companies. So we've built power plants, bridges, tunnels, we've modernised equipment and fleets. And I think the case study that Jenny will walk through around Aligned Data Centers will really bring this to life. And I think from a portfolio perspective, obviously inflation is very topical as we come out of the COVID period. And that question around, how is infrastructure performing? The clear insights we have on the ground is infrastructure is a good place to be. All businesses in the US are experiencing higher costs, wage inflation, higher interest costs. But for infrastructure, you have that stronger ability to offset or mitigate these high costs through pricing. Because what we are delivering are essential services to local communities. So that's really what we've observed over the last 12 or 18 months. The embedded inflation hedge that gets so often discussed with infrastructure, it's actually been effective. We've seen this across so many of our businesses, and where we are today is we have higher price per unit across all of our businesses. But then if you really draw it back to sort of the how of our business, which is what this slide covers, what are our differentiators? What's our proposition to clients? It comes back to those key points around our experience, our deep sector expertise, our track record, and then our operational focus and being particularly focused on growth. And so if we then put our infrastructure platform in the Americas in the context of the broader market. So what you can hopefully see from the chart is infrastructure has been a growing market for opportunities over a number of years and across a broad range of sectors. Hopefully what you'll also see and notice is that energy provides a bigger part of the opportunity set in the US than most other infrastructure markets globally. We've listed there a number of thematics that have been driving the private infrastructure investment opportunity in recent years. Now, I think there's two key points to take out of that. One of them is a number of those involving investing in and growing and improving companies, which really suits our operational skill set. But a number of these thematics, while they've been strong in recent years, they're actually, we reasonably expect they're going to drive even more opportunity going forward. So in areas like digital and energy transition, and that's also going to pair up with the Infrastructure and Jobs Act, as well as the Inflation Reduction Act that Will's going to give a lot more detail on shortly. And then when I think of our platform and how it addresses this opportunity, we not only have a traditional infrastructure business, but now that we're combined with the green investment team, we really have expertise across all of the major sectors and can really address the market opportunity. So we're in a large and growing market opportunity, and we're really well positioned to take advantage of that. So with that, I'll turn over to Jenny to give more detail on our approach to investment management.
Thank you, Carl. Hi, good morning. My name is Jenny Chan, and I'm a Managing Director with our infrastructure team. Like many of my colleagues, I've been with Macquarie a really long time, 21 years in fact. That's a year longer than Carl, and I'm not competitive. Very happy to be here to provide an anecdote about our business. In the next few minutes, I'm going to talk about our approach to active asset management and provide an example through one of our portfolio companies being Aligned Data Centers. So our goal in asset management is to improve performance and drive earnings to create value. So when we talk about asset management internally, we talk about this System 7 framework to help us identify management focus areas. As you can see, there are 7 components clearly, but we can also think about this in 3 different layers. At the heart of it is understanding our stakeholders, whether it's customers or others, to remind us of who we need to be delivering for. In terms of our second layer, this is developing a business vision, so how we want to grow the business. And then lastly, the third ring, we want to have the right operational, financial, and risk framework in place to support 1 and 2. So maybe starting with that foundational framework, one example of what we're trying to do here is the example that Ben and Carl talked about. This is how we want to elevate safety performance culture. So within our teams, MAM developed something called SAF, our Safety Alignment Framework. And this is an 11-point governance toolkit which requires our board members to think about various initiatives from transition plans to appropriate board reporting, having physical site visits, incentives and training to actively promote safety. And this has no doubt been instrumental to achieving the 60% reduction in lost time frequency rates that we've achieved across the portfolio. We similarly have an equivalent framework for sustainability, and that's helped us to deliver board-approved net zero business plans for 100% of our portfolio companies in the Americas, which were acquired 2 years or more ago. And then similarly, we think a lot about leadership and management teams and having the right incentive systems in place to achieve proper alignment. On the financial side, while leverage isn't a key driver of our returns, we're very proactive, ensuring we think about having flexible structures and accessing the market opportunistically when the windows are open. The last highlight I'll make is about our strategic vision. What this really means is identifying the drivers of earnings growth. And across our portfolio, we're generally looking to achieve high single to low double-digit earnings growth. So I'm going to talk about Aligned Data Centers, which may be a good way to illustrate how we think about asset management in practice. So Aligned is a hyperscale data center, which means it sells power, space, and cooling to technology companies. We acquired this business in 2018, and we wanted to because it's been clear for a really long time that we live in a world that increasingly uses data. We stream content, we run business applications on the cloud, we rideshare, and so forth. So we had a really strong view that Aligned would benefit from favorable trends in demand for compute power. And our vision was to help this business grow. So we implemented various operational initiatives. We helped to recruit and supplement an already strong leadership team. So a construction expert, a COO, a chief revenue officer. We also invested significant capital, over $1.3 billion, to help support growth, which took the business from 2 locations in Dallas and Phoenix originally to the 6 markets that you see on the map, including Ashburn, the home of the internet. And in doing so, we supported growth from 20 megawatts of leased capacity to a book today of nearly 500 megawatts. So that is a lot of growth and a lot of earnings growth. And through our ownership, we also opportunistically refinanced Align's debt, starting initially with relatively expensive property-level construction debt, moving to a corporate facility, and then more recently to a sustainability-linked securitization, which has lowered financing costs. With our support, Align has also recently signed an acquisition to acquire a data center platform in Latin America. We did this partly because it's an attractive risk-return proposition, but also partly, going back to the bullseye in our System 7 framework, Align's customers were looking to have access to a Pan-Americas platform. So as you can see, Align's growth was really supported by design through active asset management. We want to improve performance and grow earnings, and that's the approach we take across our portfolio. Shifting gears and to now discuss green investments, I'll turn to Will.
Good morning. Thanks, Jenny. My name is William Dimas, and I head up the green investment team here for MAM in the Americas. Really appreciate the opportunity to speak to you all about a major trend that's driving growth for our business here in the Americas, and that's energy transition and decarbonization. If you haven't heard about it, you'll hear a little bit about it now. While I don't have the tenor of many of my other colleagues here, I do have one thing on them, is that I'm the only one that's come back. So I recently returned to Macquarie after working for a few years at other asset managers, and before that I was part of Macquarie Capital's renewable energy principal investment and advisory team here in the U.S. as well for 6 years. So I knew what I was getting into when I was coming back, and I was really excited about it, particularly around the move of GIG into MAM as well. I think we all, for many reasons, we all believe that made a lot of sense. But the timing of the move, although it was a bit coincidental, because at the same time, over the last year, we received a gift. We received a gift that has increased the attention and focus on the exact areas of energy transition that we in MAM are focusing on and have been investing in for years. We've successfully been investing in platforms around the energy transition and backing teams in the Americas and beyond. So we believe we are well positioned to continue to play a leading role in what we believe will be the largest investment opportunity of our generation. In the Americas today, our team is about 30 people, but we're really part of a larger global team. We're focused exclusively on investing in the exact areas which are now gaining huge tailwinds through public policy and other support. The opportunity for our team became even larger and more tangible last year through the passage of the Inflation Reduction Act. The Inflation Reduction Act is the largest climate change legislation ever passed to date. It will provide $369 billion of support for climate change technologies and electric grid improvements, largely through tax credits and grants. This unprecedented level of federal subsidies will lead to significant private investment opportunity that will drive growth for our business. The IRA not only extends the support made available for core renewable technologies such as solar and wind, but it also provides support for many emerging technologies that were previously viewed as uninvestable, at least in the near term. The IRA has changed that overnight. Take, for example, green hydrogen. This is an area, a technology that a year ago we found just academically intriguing, but we didn't really believe there was going to be any near-term investable opportunities that were appropriate for us to invest on behalf of our clients. Post the IRA, the US has actually become the most investable place for green hydrogen. We're actually evaluating a number of different opportunities that we think will actually get built in the near term and will provide the appropriate risk return balance for us in the Americas. So you can see just how the impact of the IRA overnight has really provided a lot of tailwinds for us in this market. So our strategy is to continue to build and invest in energy transition platforms, and we're going to do that through raising a series of funds really focusing on a long-term investment horizon, because we just think that is the way to invest in this sector. It's a long game, and we need the capital and we need the focus and patience to play it all the way through. So I'm going to double click a little bit into the IRA and why it's so critical and important, and how it's going to impact our business. The main reason why the IRA is so critical is that it will reduce costs of renewable energy generation and other clean technologies. This cost reduction will lead to greater deployment of clean technologies in a shorter period of time than previously anticipated. The main drivers of these cost reductions will come from an abundance of tax credits now available to a number of technologies beyond just solar and wind. Technologies such as hydrogen, carbon capture, renewable fuels, battery storage, all now qualify directly for some sort of tax credit. And in some cases, that tax credit can now be monetized through a direct pay mechanism, which means the US government will actually cut you a check once you build a project, and you'll get a subsidy through that manner. But some tax credits are not eligible for direct pay mechanisms, but they have now become transferable, meaning that you don't need to monetize them using complicated third-party partnership structures, which previously limited the universe of tax equity investors who were willing to come into these projects. So it's a subtle but a very, very, very important change in the regime. What this means is that many new projects will be enabled that may have otherwise never happened. As you can see on this chart, this is sort of an illustration of what the impact of these tax credits really have on these various technologies. If you look at the top, we have solar, which we believe the cost of generating solar will come down about 50% due to the extension of these tax credits. To put that in real terms, in 2022, pre the IRA, there were 30 gigawatts of new solar capacity built in the United States. We think post-IRA, that number will eventually reach somewhere between 90 and 100 gigawatts a year over the next decade. So if you put the math together, that's a huge opportunity for us to capture and to deploy capital for our clients and for the business. So this slide here demonstrates how we're going to do this. I get really excited when I see this slide, as it really lays out the strategy that we have in the green investment team to take advantage of the opportunities in front of us. If you look on the left-hand side, we have kind of the technologies that we describe as phase one of the energy transition. That's really solar and wind, and these were technologies that are focused on the decarbonization of the power system. And as I mentioned just now, if we're building 90 to 100 gigawatts of this a year, this is going to be a massive volume opportunity for us. And we are going to just build in order to get to our 2050 net zero requirements. So that is going to be a big part of our business, and it already is based on our track record and the investments that we've made in the past. But to the right-hand side of this chart, you'll see many new technologies that maybe are less familiar to you. But these are all areas that we have purposefully and strategically decided to focus on in our business. And it just happens to be that these are also the areas that are getting increased support from the IRA. That was coincidental, but it does demonstrate sort of the overall trend of us in MAM being ahead of the curve. We skate to the puck, right? We don't wait for the strategy to be given to us. So we've set out, created a strategy, and we're now benefiting from the support that we're going to get from the IRA. I think that's really important to take away. So I'm going to talk a little bit about what we've done and how we're doing it. As I said earlier, this is not a new journey for us. We have a track record in the energy transition thematic. One example of that many of you are probably familiar with is our investment in Savion, which is a solar platform here in the United States. We acquired that business with 20 people or so and grew it over a few years to over 100 people and really sort of created value And then, as you know, we were able to realize that value through the sell down to Shell last year, which was really important because that's a huge global partner of ours. But we've also begun to invest in other platforms outside of what we've done in the past. And although we don't have 56 portfolio companies like our colleagues in the infrastructure side of the business do, we're catching up. We're going to get there. One of the investments that we've made is into a solar and storage platform called Treaty Oak. This is a Texas-based solar developer that we acquired 100% interest in last year. But we're going to really transform that business. Before, it was a business that developed solar projects and then sold it to third parties once they were ready to be constructed. What we will do is transform that business to not only develop and construct these projects, but also to own these cash flows for the long term. We think that this business has the capability of producing up to 1 gigawatt of new solar projects per year, which will equate to significant investment opportunity for us. Another portfolio company that we've made investments in is Calibrant Energy. This is a joint venture that we created with Siemens to deploy distributed energy, microgrid, and other technologies for commercial and industrial customers. Many of you had the chance to see a really interesting installation project that Calibrant owns in New York City on the roof of the Javits Center, which is a big conference center in the middle of Manhattan. Calibrant developed, built, and now operates that facility, and we're really proud of that in New York because that's a very well-known convention center, and it just shows how we are actually involved in our community and not only building these assets, but giving back to where we live. Finally, we also have made an investment, as you've heard earlier, in a business called Inspiration Mobility Group. That is a fleet electrification platform that's focused on fleet leasing and development of electric vehicle charging infrastructure. We're actually going to show you a short case study video on that in a minute. But before we do, I just want to give you one interesting fact. Inspiration actually leases hundreds of Teslas to the largest car-sharing network in New York City called Revel. I know many of you will be heading there after this, and so if you need to get around the city, I highly encourage you to download the Revel app and use that to get around. You'll be reducing your carbon footprint, and you'll also be paying yourself. So I don't see how that's a win-win for all of us. After the video, we're going to have a short 10-minute break, after which Sean and his team will come and talk about the public investments business. Thank you.
We are an EV solutions company working with commercial fleets to help them electrify their operations and transition to a net zero electric fleet. And what we do to do that is really design, implement, and finance all the infrastructure, both vehicles and charging and energy infrastructure required to operate that fleet.
Macquarie Asset Management invested in Inspiration Mobility in December 2021. So what's holding up mass adoption is no longer the cost, but making it easy to switch. And that's what Inspiration Mobility seeks to do with this product. By offering both the vehicle leasing and the charging infrastructure build-out, a customer can go to Inspiration and get a one-stop solution to transitioning their fleet from gasoline to electric.
So truthfully, we think of ourselves as pretty unique in this respect because we have an integrated offering that combines all the elements of successful fleet finance and fleet procurement and fleet management with clean energy, infrastructure development, and real estate. And those disciplines tend to be very siloed, both in organizations and in commercial businesses. But bringing those things all together under one roof and designing a fleet, especially a diverse, complicated fleet of many different vehicles, many different use cases, kind of optimizing that and designing that as an electric fleet, and then building and operating the charging infrastructure to make it seamless for the fleet operator. That's what we do that really nobody else does together.
There's so many corporations out there that have decided they want to decarbonize their operations and reduce the risk that is inherent in having carbon-intensive emissions with their products and services. But not all the solutions are easy. And to transition this fleet from ICE engines, internal combustion engines, to EVs is actually something they can do today and reduce costs. But it's not always easy, because you have to figure out how to tap into government incentives, you have to figure out how to charge them, you have to make sure the use case fits, you have to figure out exactly how long these cars are going to last and how to manage the fleet overall. And all of those things are just different from an ICE engine, and Inspiration Mobility is a source of solutions.
Inspiration supports our clients in a variety of ways, from traditional fleet management services like titling and registration to uniquely Inspiration offerings like decarbonization metric reports and what we like to call continuous commissioning, where our EV transition team identifies certain vehicles at different points that make the most economic and environmental sense to roll off. Our customer service team has weekly touch points with each client, and our fleet operations team maintains close connection with each OEM to maintain the best pricing and understand availability of when EVs are coming to market.
Macquarie Asset Management is actually pretty well positioned to support a group like Inspiration Mobility. The Green Investment Group is really designed to help bring these sorts of technologies to market and help finance them and scale them. We actually have an expertise in infrastructure and asset-backed financing and these sorts of technologies. When Josh Green and his team look to Macquarie, I think they see a group of people that not only can help them grow, but help them with local communities, help them manage a really competitively financed fleet and grow that fleet quickly, along with all the different pieces that go around the management team to make this a successful business in the long term.
Having Macquarie as a partner is like having a phone a friend who I know I can always call if I need support, if I'm releasing a new policy or process, or even if we're in a sticky situation. I always know that I have a font of information that I can draw from, whether it's something related to people or worker health and safety or sustainability. I always have a true partner there, someone who's going to help us build our business better, stronger, and more sustainably.
Okay, I hope you all had a good little break and got the espresso hit that you needed after the morning session, so we can continue on until lunch. You've heard a lot about the private market side of asset management business. We're now going to give you a short overview on the public investment side with me and my two colleagues here. On the public investment side, Ben has talked a lot about how we're providing a strong offering to our clients. And I think what's one of the things that's fairly unique about our asset management business is that we do have the strong private market side of our business and then also the public investment side. There's probably only another a dozen firms out there with a broad offering that Macquarie now has. On the public investment side, we have over $500 billion in assets under management globally. And half of that, 284, is managed here in the United States for U.S. clients and also some clients overseas. What we've been able to achieve over the last several years is to have a much more diversified business. So I really like that top chart there, or the pie, which shows how our business is now a very balanced mix of equities and fixed income and multi-asset strategies. And I think as was highlighted by Andrea in the beginning of the presentation, what's also really encouraging is that we have a good mix of institutional insurance clients, with about half of our business, and about half is wholesale clients or wealth management clients that I'll talk more about. The cornerstone of our business here in the Americas is this building here, is Delaware Investments, which we acquired in 2010. We just moved into this building 2 years ago. But that was the cornerstone of our business here in the Americas, and then we've built on that with the acquisition of Waddell & Reed's Ivy funds, and then what's complementing that, as Andrea spoke about, was the CPG group, which is really, I think, going to be a major advantage for us in the future. Ben talked about industry trends in asset management globally and a number of key trends that are driving the business. Let me just give you a little bit of perspective and kind of 4 key points on the public investment side. The first is that you've all heard about passive management, passive equity management, let me be very clear there, and ETFs. It has clearly been a dominant trend over the last 10 years. BlackRock, Vanguard, State Street, growing their books of business and active equities. There's probably a lot of people in the room who are very interested in that because they're in active equities and active equity management. It has been a dominant trend, and it will continue, but there are still a number of very attractive pockets of growth in the less efficient areas, small caps, international, global, emerging markets, and point number 2, it's very different than what we've seen on the fixed income side. Active fixed income is still the very clear dominant trend. Active fixed income funds have grown 9 out of the last 10 years. Last year was the first time in a decade we had negative flows in active fixed income. And so there's still a big opportunity to grow in both mutual funds and ETFs on the fixed income side. The third trend is about the shift that is now taking place. The trend over the last 10 years has been mutual funds into ETFs. Now we're starting to see the trend of passive ETFs, mostly equities, moving into active ETFs, where we're taking our active capabilities and actually putting those into an ETF wrapper, particularly here in the US, but also in Australia. We are primed and really focused on being part of that trend and launching strategies that can be part of the active equity and fixed income ETF wave that we believe is coming. And the fourth is that, as you see on the bottom, of course, scale and diversity is really important. And I think the general trend here is that the big are getting bigger, right? While there is consolidation of firms, and you've seen that trend in the industry over the last few years, it's also really a consolidation of mind share and shelf space in the public investments business. And we think that will continue. And with some of the moves that we've made strategically over the last few years, we think we're right on the cusp. Now being number 30 in funds under management, mutual funds, we're right on the cusp of being a major player. Andrea's already spoken a lot about the market opportunity, specifically in U.S. wholesale, wealth management, we call it. We call it a number of different things you call it here. But bottom line is, there is over 100,000 financial advisors around the country who serve high net worth and mass affluent clients. And our job is to try and target those financial advisors. And this is what's different about the US than what you see in Europe or in Asia. Typically you have a big wealth manager, like a UBS, who I used to actually work for, where there's a kind of house view, and then the bankers, the wealth managers, they implement that for the house. Here in the US, you have 100,000 or more financial advisors who are part of a firm, but basically making their own investment decisions. And so it's hand-to-hand combat of getting out to those advisors and building brand over time in the marketplace. As you see here on the right-hand chart, these are the major sub-channels within U.S. wholesale. And the ones with the biggest growth prospects and the largest AUM are platforms like Schwab and Fidelity, but also independent broker-dealers like LPL, we'll talk about more in a minute, and wirehouses like Morgan Stanley. That's a very large client of ours. And that's exactly where we are positioned and where we're continuing to lean in, because as these firms grow and grow their share, we believe we can grow our share with them. Waddell & Reed. You've heard a lot about that over the last 2 years from Sam and from Alex and from others at ops briefings. We've been very pleased with the acquisition of Waddell & Reed and the Ivy funds and how that has given us a stronger position here in the U.S. The combination of the old Delaware funds and the Ivy funds now positions us, as I was saying, as a top 30 player in U.S. mutual funds. And it's not easy to kind of get to those ranks. And then the key is how you use that scale and that visibility to really deepen your client relationships. That's also what this acquisition gave us, was not only a size and scale in our mutual fund business, but also a key strategic partner. LPL, which is the largest independent broker-dealer and has 18,000 financial advisors around the U.S., we are now their largest strategic partner. We now manage more active mutual fund assets than any of their other providers. And this gives us more access and allows us to, as you've heard from some of my other colleagues on the private market side, innovate with them to figure out new ways that we can serve their clients over time. It's early days, but we are starting to see, and Kim's strategy, who you'll hear from more in a minute, has been a beneficiary of us getting better shelf placement and more access to their financial advisors. And the last point on the acquisition was, of course, is that have we met the metrics? Have we delivered? The answer is yes. From a milestone standpoint, in terms of the integration, we hit all of our major milestones and completed the integration at the end of 2022. It has met our expectations in terms of cost takeout and synergies and the scale that it's providing to the platform. And I think FY24 brings us to a new chapter where it's all about how do we then now drive that or turn that into growth for our business over the next 3 to 5 years. We've been very pleased with how that acquisition has gone. And one other thing I would say about that is it takes a village. Right? It wasn't just public investment sitting here in Philadelphia that was working on this deal. It was every single part of Macquarie. Lawyers in New York, operations and tax people in Australia. There were so many people involved to actually execute a deal like this in an effective way. And it really showed the power of Macquarie Group overall. Just turning briefly to the market environment, I don't need to tell everybody in this audience how tough and challenging 2022 markets were, but they were bad, economically and from a market returns perspective. And from an equity perspective, when you look at that top chart, these are three-year rolling returns, annualized rolling returns. And clearly, this period, we are seeing a downdraft here. But it's not as bad as the tech bubble burst, or when I was a portfolio manager, equity portfolio manager, when the GFC happened. That was some real carnage that we saw here. This pandemic induced downturn, which can last for a bit longer, is tough, but will we believe will not be as difficult of a cycle as we saw just in the GFC. But we do believe that we are entering a new chapter. After the GFC, we had the wind at our back in this industry. 10 years of double-digit equity market returns that were helping to rise the tide on all boats, right? This new chapter, as we come out of this pandemic-induced downturn, we believe we're going to have more subdued equity market earnings, and then, of course, returns going forward. The bottom chart, actually, and I was down in Australia just last week, is a different story here in the U.S. than what you might see in Australia or in some other markets. This past year was the worst year since the U.S. Depression for the average investor or average retiree in a 60-40 portfolio, right? Because you had the big downdraft of equities down 25 and actually total returns on fixed income down double digits also. And my colleague Greg may talk about that a bit more in a minute. But that was a significant amount of pain, particularly if you think about those people who are right before retirement, which is a huge slug of now the end of the baby boomers. That's a lot of uncertainty for them in terms of what their outlook is for the next 5 or 10 years. And we also believe that means that there's going to be a lot of money in motion. Once the central bank cycle starts to abate, people have a clearer view on where the economy is going. We think in 2024 into 2025, you're going to see a significant amount of money in motion within fixed income, within equities, across asset classes, and, as Andrea pointed out very clearly, towards alternatives in the future. And so, we're continuing to build scale and grow our assets. I think Ben highlighted this chart at the beginning of the presentation, but as you've seen, we're very proud of how the assets have continued to grow, but also the efficiency of the business in terms of assets per head. And as we've done this, we've been through an evolution. We've continued to add more capabilities to broaden out our platform, and that really is capabilities that are going to help build the story over 3 to 5 years and beyond. Things like small cap, emerging markets debt, model portfolios, and now Ivy Growth Equities joining the ranks. We've also been doing some harvesting on our portfolio, like in Korea, which you've heard about, or things like Jackson Square Partners that we sold 2 years ago. But the trajectory of the business is clear, and we believe that if we continue to execute, continue to make sure we're investing in our existing capabilities, strengthening those capabilities, and delivering strong alpha and active management in our strategies, we do believe that we can continue to grow this business in the future. So with that, I'm going to turn it over to my good colleague, Kim Scott. She's a newer member of our team. So I've only been here 8 years, so I'm a young newbie by comparison to some of my colleagues here. And Kim has actually been here too. But she's been a really strong addition to the team. Part of the Waddell & Reed acquisition was about cultural fit and also investment talent. And we couldn't be happier with the team that we've been able to bring over into Kansas City as part of Macquarie Group, and the great leadership that Kim Scott's providing as part of that team. So over to my colleague, Kim.
Thank you, Sean. He's right. I cannot go toe-to-toe with anybody in this room on tenure. However, my team did win the Super Bowl in a very competitive game between the Chiefs and the Eagles. So, good morning. I'm Kim Scott, and I have been with Macquarie for 2 years, and I've been with the Ivy organization for 24 years, where I've been the lead portfolio manager on the mid-cap strategies for over 2 decades. And I should probably advance this slide. There we go. Are we in the right place? Nope. There we go. Yep. So I've welcomed and enjoyed being part of Macquarie. The cultural fit between our organizations is strong. We have integrated closely with the team in Philadelphia, and I've thought from the beginning that we are the Midwest version of them, and they are the East Coast version of us. It's a good fit, and we are all Macquarie. So I'd like to share some highlights of the equities platform in the Americas, and as you can see by the slide, at an AUM, combined AUM of these organizations of about 125 billion, we are almost half of the AUM of the public markets in the Americas. And as you've learned through some of these presentations, all of these presentations this morning, the market in the Americas is massive, and it provides significant opportunities for growth across the equities platform. And the combination of the existing Macquarie equity capabilities and the acquired Ivy strategies presents a scaled opportunity of complementary capabilities across large cap, mid cap, small cap, and international in both the growth and value categories. And we offer strategies in what are somewhat inefficient parts of the market, including the mid-cap space in which my team invests. This is a space that perennially offers very strong risk-adjusted returns, yet it's underrepresented in investor portfolios, and we have very strong offerings in that space. So across the equities platform in America, these complementary capabilities are geared to capture more of this very large market. And the strong cultural fit, I think, between these two organizations is of benefit as we go to market together. We work together very well. Broadly, we have fine-tuned a set of global support functions across business analysis, distribution, across sustainability resources, trading, and quant support. And all of these functions allow the investment boutiques to spend most of their time and effort investing. And as you can imagine, we are a fan of that as investors. And we do see meaningful growth opportunities in expanding our existing capabilities across active ETFs, separately managed accounts, and in the institutional channel where there is a lot of greenfield opportunity still for our strategies. And I am a proud representative of the Ivy Equity Boutique, which is also proudly part of Macquarie Asset Management now. The Ivy Equity Boutique is based in Kansas City, having been founded there as Waddell & Reed in 1937. This is an investment organization of 6 portfolio management teams managing 7 strategies, and we are supported by 16 analysts who are subject matter experts in their covered economic sectors. This is an organization with a long history, a strong investment culture, and demonstrated results with 65% of the fund AUM ranked 4 or 5 stars by Morningstar. Culture is key to our success. This is a very experienced and collaborative team of portfolio managers and analysts who have worked together for a very long time. And as an example on my team, the portfolio manager tenure at the firm is 24 years for me, 20 for Nathan Brown, and 15 for Brad Halverson, both of whom are co-managers on the mid-cap strategies. And the tenure of many of the analysts who support us is likewise impressively long. We know each other, we like each other, we challenge each other. We have built a collective and cumulative knowledge base within Ivy that we share and pass on to each new generation of analysts who often become portfolio managers. And a key and important aspect of the acquisition and the integration is a support structure that moved out of Ivy and into Macquarie, while the investment teams have continued to independently manage their strategies according to their unique process and philosophy. So a lot of autonomy, again, something we very much appreciate. And that is Ivy Equity Boutique in a nutshell. And I thank you for your time, and I'll pass it on to Greg Gizzi, my colleague. Thank you.
Thank you, Kim. My name is Greg Gizzi. I've been at the firm 15 years, and I run our U.S. fixed income business and also lead the municipal bond team. I want to tell you how happy I am to present to you today, but the truth is the two happiest beings in the world are my two dogs, who were my involuntary audience this weekend working on this pitch, and they had their paws in their ears by Saturday afternoon saying, no mas, please stop. Asset management business, 3 key elements, I believe, lead to success in the business. And I think enthusiastically, I believe all 3 of those exist here at Macquarie. First, clients want their managers to not just deliver good products, but they want you to become their solutions provider. And use your skill set and your agility to craft those individual solutions that all of my colleagues have talked about today to fit their own specific needs. And when I think of that client-centric focus, to me it represents the DNA of this firm. It's what we breathe and live every single day we show up here and work as a fiduciary for our clients. So the fixed income platform in the US, it's a broad platform with many offerings that we can tailor to fit the individual needs of all those clients. And I want to walk you through some of the metrics in the business today. So we represent the US component of a global platform, and we manage $133 billion out of the $275 billion that's managed globally. We have a global client base. 150 clients are represented in 14 different countries. 70 of those clients are US fixed income clients. And again, as Kim said, it takes a village. It takes every component of our investment team and our firm to bring together those holistic solutions for every individual client. 86 of our 134 fixed income professionals across the globe reside here in the US. 21 years is the average experience of a fixed income professional here. 15 and a half years, or roughly 3/4 of their career has been spent right here at Macquarie. And I think that speaks to the deep experience and consistency that our clients are looking for in their staff. We have 2 investment hubs in the US. Philadelphia is our global headquarters, and then New York as well. The other 2 are Sydney and London. And when I think about gaining credibility with our clients, one of the most significant aspects, and my colleagues have touched on this earlier, is investment excellence. If you look at the America's flagship strategies, 93% of those strategies are beating their benchmarks over 5 years. 100% of those strategies are beating benchmarks over the 10-year period. So when I think about this department, it has tenure, it has deep experience, it has investment excellence, and we partner and collaborate with every single component of the firm in order to develop those holistic solutions for every one of our clients. The middle of the slide shows our 6 pillars, our capabilities in fixed income. Emerging market debts, municipals, the team I lead, private placements, corporate bonds, leverage credit, and U.S. multi-sector. For me, the key takeaway, we have products, credible products in all of these pillars that are attractive and appealing to every single one of those investment verticals that Sean was talking to on the wholesale side, but additionally gives us the capability to compete in the institutional markets as well. So Sean mentioned the 60-40 and how difficult markets were last year. I'm going to give you the silver lining of that experience. There is, for the first time in a while, yield for fixed income portfolio managers, right? We've had a tremendous sell-off in the marketplace. And yes, there is this dance with the Fed for investors. Are we going to continue to see the Fed hiking rates? Are we getting higher for longer? We're not getting higher forever. And our house view is that that's going to turn at some point this year. We were looking at early summer. Maybe it's a month or two earlier, depending on how many more hikes we get. But we already are seeing evidence of inflation dissipating. And I would believe Jerome Powell and his staff, they are going to contain inflation. And the money and the money in motion that Sean was referring to earlier will come back. And I believe as demographics continue to change, a lot of that finds its way into the fixed income markets. So we are well positioned to take advantage of that. Our America flagship strategies have the long-term performance, the deep teams to grow the business organically. But just as important, we have the infrastructure in place that will allow us to smartly grow our business inorganically in a synergistic fashion. And that's precisely what we did with Waddell & Reed. We got about 30% of the asset base. We literally hired 3 people. So decent revenue run, not a big increase in costs. And we will continue, as all of my colleagues mentioned today, to innovate and create new capabilities. One of which I want to highlight today in a moment, which is a new municipal strategy, a new high-yield platform. But we have other strategies such as Sean mentioned emerging markets, which I believe will be a growing business for us in the future. Our emerging market debt green opportunities as another example. So before I get to the actual platform, I think it behooves me to just spend a minute for those of you that might be less familiar with the municipal market, just to give you a quick overview. So in the United States, state and local governments and their agencies can access the capital markets through municipal debt, and they will receive federal tax exemption on those proceeds if the proceeds are being used for a public purpose. So many of the same sectors that my colleagues here invest in can also get capital in a very cost-effective manner in the tax-exempt markets here in the U.S. It is not a bottomless pit. There are restrictions. There are restrictions on the amount of debt that can be sold, and there are restrictions on the use of those proceeds, which provides the opportunity for David and his team. It is roughly, according to the last update from the Federal Reserve Z1 report, just over $4 trillion. It's a very viable market, and probably the biggest change in the marketplace since the great financial crisis has been the increase in the amount of taxable debt issued in the muni space to take advantage, or avoid, I should say, those restrictions on the use of capital. So what have we done? So one last thing, important. That tax exemption, you would imagine, makes it very attractive for that category that Andrea referred to, those high net worth individuals, right, that are at the upper tax brackets. And what it does is essentially create a unique ownership structure in our product, in the municipal asset class relative to other fixed income asset classes. So 70% of the municipal market is held by individual investors in some form of retail product. So what this does is when we get in markets like last year and there's extreme inefficiency and volatility, our market tends to get oversold, becomes very attractive relative to other components within the fixed income arena. So what we've done here is designed a platform that will precisely take advantage during those volatile times of these inefficiencies and allow us to be capitalize on those opportunities as they present themselves. And at the same time, in normal markets, we'll utilize other strategies such as leverage and derivatives that we don't typically use in other parts of our municipal platform. And lastly, this trend came up amongst almost all my colleagues. We're going to capitalize on the market shift as well. The structure is designed to address the ever-increasing need that advisors have in the U.S. to make an allocation to that alternatives bucket. So this structure will allow them to allocate to an asset class they already understand very well and allow us to scale our business without any additional additions to our infrastructure. So I want to thank you all for your attention. I'm going to turn it over to my colleague Graham Conway for developing solutions capabilities.
Thanks, Greg. Hello, everyone. I've had the pleasure of being at Macquarie for the last 26 years working across our infrastructure and asset management business. And during that time, after starting in Sydney, I spent 11 years in London and the last 10 years here in New York. As head of the Strategic Solutions Division, my role is to take that global experience and that knowledge of our business and try and find better ways to take our products and skill sets to better meet our clients' needs. It's impossible to think about our clients' needs without giving that some market context. And in that respect, there's 6 key trends that we try and assess ourselves against as we think about our own growth and where we're going to go with our clients. You've heard some of my colleagues mention this already this morning, and one of the key thematics we're aware of or see is that our clients want more products and more services from fewer managers, and they want better value. As we think about that in terms of where we're growing, we're constantly looking to our clients as to how we deliver them more of our products and services, and then take those same products to new clients in the market. As part of this happening across our sector, the industry is consolidating. We too, as you've already heard today, strategically or opportunistically are looking for opportunities to expand our business, to add new skill sets and to add new capabilities. As the industry's thinking about how to grow, partnering with clients is incredibly important. And across the industry, we're seeing opportunities to form greater and deeper relationships to build longer duration and more permanent capital. An incredibly exciting opportunity and something I'll touch on in a moment. As Andrea and Sean have already mentioned, retail capital growth and their under allocation to alternatives is a very real trend and dynamic, and the democratisation of asset management is facilitating that growth. And finally, ESG expectations are most definitely rising. I think as Hamilton said, if you don't stand for something, then you fall for anything. And as we look across the ESG market, investors, whether it's looking how to assess long-term investments, whether it's looking how to manage their portfolio to selection, or whether it's just thinking about the data and the analytics they need for us, ESG is an incredibly real part of our business going forward. The asset management industry has been gifted with some really strong industry fundamentals. Over the last 5 years, we've seen incredibly strong growth across the industry globally, and that's forecast to continue in the years ahead. Perhaps more importantly, though, is the composition of that AUM growth. So if we look 5 years ago, the balance of global AUM was about 50% retail and 50% institutional investors. Today, that number's roughly 60% retail. And if we look 5 years ahead, roughly 2/3 of global AUM will come directly from retail investors. Perhaps more, or further, the next generation of retail investors is changing. If we look in the US over the remainder of this decade, the growth in financial wealth of Generation X's and millennials far outweighs that of the baby boomers, the generation that's dominated our industry globally over recent decades. This next generation is driving many of the trends I've already talked about. They're more digitally savvy, but survey after survey also shows that they're much more focused on the ESG trends that I've already mentioned. Something we think is incredibly exciting when we consider our own capabilities that Will mentioned earlier this morning. When we look at Macquarie Asset Management, we believe we're incredibly well positioned to succeed in this new world. We have an incredibly diverse client base and a wide range of product capabilities. As you've heard mentioned from previous speakers, we have a broad retail base to complement our deep institutional global base. This makes us unique amongst the world's largest alternatives managers. Macquarie's capabilities are diverse across duration, sectors, and liquidity. But most importantly, our client base isn't evenly distributed across those products. And there's a huge near-term opportunity for us to take our existing clients and existing products and increase the exposure of those clients to new opportunities and new products that we have. Our infrastructure business is a classic example of this. You've already heard that it's our largest business, but hitherto it's been dominated or is dominated by institutional investors. When we think about the increasing public awareness in not just the United States but globally of infrastructure, we think about legislation like the Inflation Reduction Act. The awareness of infrastructure amongst retail investors is growing at an incredible rate. And we see a huge opportunity to take what's to date been institutional product into this retail market. The Central Park acquisition that you have heard about already that we completed in early 2022 is all about increasing our skill sets and knowledge and capabilities in this area such that we're better placed taking these institutional products into these new markets. All in all then, we think we're incredibly well positioned and well placed for the democratisation of alternatives and a huge opportunity to expand both our clients and our products and cross-sell across these areas. To do this, the key is to solve problems, not to sell products. What are our clients investing for? What do they want? What characteristics are they looking for? And how do their investments with us fit into their broader portfolios? To get that information, to learn that understanding, we have to form broader relationships with our clients to really understand what they want and what they need. But we need to do more than just listen to their problems. We then have to deliver them solutions. And having done that, as Ben already mentioned at the beginning of the day, we've got to deliver best-in-class investment performance to back that up. In terms of areas where we see some great opportunities, there's three worth highlighting. In the insurance side, we already have an incredibly diverse and large clientele across the insurance industry. We see a huge opportunity to invest in our capabilities and our products to expand those relationships and to develop more permanent and longer duration sources of capital across this area. A huge opportunity for growth. You've heard about our green investment capabilities, and we see a really exciting opportunity there to develop carbon solutions in conjunction with our clients. So not only are we delivering them great investments, but we're helping them meet their own carbon objectives and targets and aspirations for the future. And finally, I'd like to pass over to my colleague Wendy Ho, who'll talk to you about our secondaries initiative, talking about how we're seizing a business opportunity to expand into an adjacency, to grow a new business in the process, offer our clients a new service. Thank you.
Thank you, Graham, and welcome everyone to Philadelphia. While home has been New York City for me for almost 25 years, Philly is near and dear to me because I did grow up only 15 minutes away from here and spent almost every weekend of my childhood right here. So I'm very excited to be here today. Similar to Kim, I've only been at Macquarie for a little over 2 years after spending over 20 years in private equity, infrastructure, secondaries, and entrepreneurship. But in the time that I have been in Macquarie, I have found the entrepreneurial spirit and culture to be particularly rewarding in my own experience in building and launching the secondaries business here. Earlier, Graham spoke about building solution capabilities for our clients, and I am here today to give you a practical example of the infrastructure secondaries business that I am building and leading today as part of our solutions offerings. You might ask, why secondaries? And you heard much today about growth in the private markets. And secondaries is an area where we see sizable growth opportunities. It is mainly driven by three trends that we observe in this market. One is the growth in the alternative asset class. Second is the continued maturation of this asset class. And finally is the need for liquidity as more and more investors invest in this space. For MAM, we asked ourselves, where do we want to focus on secondaries to capture this growth opportunity? And our answer was infrastructure secondaries, as MAM is very well placed for this natural adjacency, given our decades of experience in infrastructure. What captured our attention also was the potential in infrastructure secondaries, was the growth in the infrastructure private markets in recent years, and the nascency of the infrastructure secondaries market. If you look at PE secondaries today, it is nearly 7% of the AUM of private equity, whereas infrastructure secondaries is just a little over 1%. That 1 to 2% number was the number that PE secondaries saw just a few years ago. And then combine this with the potential for the growth in the infrastructure private market asset class itself, we can see almost 7 times the market size in the next 5 years. We also saw that experience and knowledge and expertise is really needed to appropriately invest and underwrite in this asset class. So therefore, we're bringing here at MAM a specialist approach to investing in secondaries versus the generalist approach that's more prevalent in the secondaries market currently. Finally, how will we do this? We will execute a diversified approach in investing by acquiring positions from investors to provide liquidity for them, but across a wide range of infrastructure funds and assets. Thanks for your time today, and I'll turn it back to Ben.
Thanks, Wendy. And thank you, everyone else, for your patience today. We've obviously been talking at you now for a long period of time, so I suspect you probably want to ask us some questions. I know a few of you, so no doubt the shopping list of questions are being formed or have been formed already. Before I do that, the first thing I just wanted to say is I think it's a great idea that Shamar and Alex and Sam had to actually take the ops briefing out of Australia and bring it here. I hope you have a great 3 days. We're certainly really excited to have you here, but just as importantly, I think it's great that you get to meet more of us than less of us. You know, we're about the more rather than the fewer. And hopefully what you got a sense of today is that everyone who spoke to you is a leader and an investor. We're not managers. So these are people who every day, certainly from a MAM perspective, are focused on making sure that our teams have the right culture, making sure we understand how to price opportunities, but in particular thinking about discharging the responsibility and the privilege of being a fiduciary for clients all around the world and then their underlying clients. And I think we had pretty good message discipline, but in case you missed it, there are 3 things we'd like to leave you with. We're excited about America. We think it's a huge opportunity. And so after sort of 20 years as MAM, we think in many ways we're just getting started here. And I think you'll probably hear a similar message from Nick and his team and Michael and his team over the next couple of days. For us, the big focus is really about broadening and deepening partnership with a whole range of different types of clients here. This is the biggest capital market in the world. We have built a good platform here, but there's a lot more we can do, whether it's with wholesale clients and penetrating those channels or just with existing institutional clients. And the good news is we've got momentum and we're starting to win mandates from clients that we haven't previously had. That is hard work. They want to sometimes meet up to 40 of us and they're looking at us from a due diligence point of view from all different angles. But we've got a good story to tell and a great track record, and so we're winning our business there. There are lots of different thematics across the Americas, but in terms of some of the biggest thematics, both globally and obviously in this market, we're well positioned to deliver on those, whether it be energy transition, whether it be digitalization, or whether it be people thinking about, hey, I need more exposure to alternates. And, I need within that, exposure to things other than just PE. And then lastly, we think we can continue to grow and scale our presence through acquisitions and adjacencies. So, they're the key messages we wanted to leave you with today. And with that, maybe, Sam, we can turn over to questions.
Great. So we've got about 25 minutes. We're going to do an office tour after this and then have lunch. Then we'll go to neutrality. So about 25 minutes. Obviously, most people here are coming to dinner tonight. So if you don't get your question in, obviously plenty of time to do that. We have got some microphones around the place, so we'll just open it up to the floor. Maybe start near the microphone there, Andrew Triggs.
Thanks very much, Sam. Andrew Triggs from JP Morgan. Maybe just starting on the public markets business and on just the risk of ETFs. I think it was mentioned in passing by Sean, but what is the risk that ETFs gain a greater hold of the fixed income market? I think it's, correct me if I'm wrong, but probably running about 15% of total versus 50-50 for equities.
Yep. So probably two things before maybe I hand over to Sean. I think the first thing is we've all been watching the rise of ETFs, and no doubt they'll have a place to play. Just as they have in equities, they've had a place to play in fixed income. We do think there are actually some growth opportunities for us in terms of active ETFs, and we think that's a good way to transition some of our mutual fund clients into a different vehicle which is more attractive for them, potentially from tax and also from a liquidity point of view. So we look at that market and both think, well, that rise, and look at it both as, yeah, we understand that for some clients there may be a move, but also we look at it as an opportunity. I don't know, Sean, what you want to add to?
And of course, Greg's the expert here on the fixed income side, but you're right. Clearly, only 15% of ETFs of fixed income has shifted towards ETFs. It has been a much slower trend than on the equity side. The reason mainly is because the benchmarks are inefficient. And, of course, you have individual securitization. It's not like a cookie cutter benchmark like the S&P 500. So there's a lot less efficiency there and a lot more advantage for fixed income portfolio managers to, provide greater yield and greater total returns for investors. So do we believe that there will be a shift to ETFs on the fixed income side? The answer is yes, but to Ben's point, it will be active ETFs managed actively to produce higher yield and higher total returns for investors. ETFs is all about the tax advantage it gives U.S. investors. That's what this is about. And that's why, while you're seeing it grow overseas, it's for very different reasons of efficiency or cost efficiency than it is about actual return. So,
Greg, anything you want to add?
Yeah, I'll just say I spoke about demographic shift with respect to allocations maybe going more towards fixed income. What we didn't talk about is there's going to be, with that shift, a lot of advisors turning their books over to another generation. And that generation is focused on different tools than the previous generation did. So we're being somewhat forward-looking. And I do believe that Sean is correct, that you're going to start to see more traditional active fixed income managers enter that marketplace and be competitive in that arena. Not all fixed income products have the liquidity or depth to do it. Certainly bank loans wouldn't work with 35-day settlements, but I do believe it's an opportunity for the firm that will embrace.
Sam, could I just ask on the private markets business, a couple of regulatory changes were mentioned in the context of opportunities for the business. But again, correct me if I'm wrong, but more than 90%, over the history of MIRA, more than 90% of transactions, asset acquisitions have been in the private-to-private space rather than public-to-private. Are they either of those sort of acts that have been enacted recently genuine opportunities for the business, or are they catalysts to change that historical shift, historical mix towards private-to-private?
Well, I'm going to accept that 90% number is right because I don't have it to the top of mind. But you're right. The vast majority of our investing has generally been in the private sphere, where it's where there are two stakeholders, generally private, even though they may be listed. But it's been a sort of a bilateral transaction. So that is correct. There's been through our history a few waves where we've seen some privatisation programs where we've benefited from that. Is there globally any sort of standout regulated or mandated privatisation program at the moment? No, there's not. I think the point that Will was making in his presentation was really about governments can create regulatory frameworks like the Inflation Reduction Act, also the worst ever acronym for an act, the IRA. And they can create that, which actually does catalyse investment. And I think the hydrogen point is a really good example. You know, before that act, investing in hydrogen was somewhat theoretical, we thought, not particularly commercial or scalable in the US. And part of it was because of just the cost to generate a unit of hydrogen. The IRA impact has catalysed focus around that because it's made it much more economic to invest. And I think that's an important thing because it will help catalyse capital move into an area where people can see the technology works, but it needs to be scaled up and commercialised. So I think that's the point we're sort of making, that there can be regulatory regimes that come in around the world where we can benefit from. And I think if you kind of go back to the the sort of currency crisis issues of the early 2000s, we saw that in some Asian countries where governments put in those programs and it allowed us to build a presence and take advantage of that. But from a privatisation point of view, that will be spasmodic and we'll take advantage of that. But often that, as you know, is a cost of capital shootout.
Thanks, Andrew Lyons from Goldman's. Ben, just a question on the positioning of your energy transition business within the private investment markets team, or the private investments team. You know, clearly in the infrastructure space, Macquarie is a global leader in that space, and you certainly have a foothold in this energy transition, which is clearly growing very quickly. However, all your competitors are talking about the same opportunity. I'd just be keen to sort of understand where you sort of think you stand within the competitive environment, and particularly where you're seeing competition particularly come from in that space.
Yeah, I mean, that's I think a really important question, is that you could go to any meeting like this for a private markets or alternates asset manager, and we can guarantee that energy transition will be the agenda and everyone will have a special edge. So yeah, you've probably seen this movie a few times. I think the difference here is we have been doing this for a very long time. If you look at the amount of capacity that we've either built or developed, or that we have under management today, or that we're investing, that would be one of the largest portfolios by far in the world. So yeah, there are a lot of people talking about this, but we've actually been doing this all around the world. If you go to a market like Taiwan, if you go to a market like the UK, if you go to a market here in the US, we have a real credibility because we've been working with stakeholders to develop these and manage these businesses for a long period of time. And that's ultimately the difference. In our asset management business, there are two things that really distinguish you. It's the quality of your people, right? We are a people-led people business. That is our advantage. And the track record you can point to. And so we're not pointing to a track record of the last 2 years, or we woke up and wanted to be aligned with this because everyone else started talking about it after COP26. We've been doing this for decades, and we've got teams that have been doing it for decades, and it goes to the scale of our portfolio today. So, the thing I would say is people often ask us about, well, there seems to be more competition in these spaces. And the thing we say is, first of all, we focus on just executing our plans, but we welcome that competition. Why do we welcome that competition? Because that is good for the communities in which we operate, because they have more choice. It's good for our clients because they have more choice, but also the world is forever short on capital for things like infrastructure and renewable energy. So we wouldn't be a leader in this sector if we didn't say it's a good thing that other people are doing this, but we certainly feel very confident that there is a big place for us to play, and we'll continue to be a leader in this space.
Thanks. And just a second question. David mentioned or spoke about the long runway of opportunity for infrastructure in the US, and it is a related question to Triggsy's, but it is something that Macquarie and the market more broadly has been speaking about for a long time, just about that opportunity. And I'm just keen to understand, is there any reason why over the next 5 years, 5-10 years, you think that there might be a real catalyst for that runway to be realised?
So I'll maybe let David and Carl touch on that, but I think there are two things. If you go back to that chart, we're raising bigger funds for the Americas, and we're deploying more capital than ever before, and we're raising those vintages faster. So clearly the opportunity set is getting bigger. I think like anything with, in asset management, things don't happen overnight. It takes 3, 5, 7 years for those markets to evolve. And the important thing is to be positioned and understand that you're going to patiently grow with that growth. And I think that's what we've been doing. And if you think about the Americas, we were principally a US-focused business. Then we moved into Mexico. Now we're down in other parts of Latin America. That's, we're being able to surface real and scale opportunities there. And then you have the overlay of, say, things like the Inflation Reduction Act, which will catalyse more growth again. So I don't think we're trying to say that suddenly overnight, things will go from, X to Y, but we do think we're growing with the market, and that market has very growth indicators. I don't know, Carl or David, if you want to add to that.
Yeah, just a quick couple of points. The thing we didn't spend a lot of time, who asked the question? Sorry, just so I know who it was. Oh, thanks, hi. There's never been an Infrastructure and Jobs Act before. So the government is actually, I'll say, finally waking up and recognizing sort of what's needed, and have put, I think that was $359 billion sort of behind, and Carl has these numbers better than I do, $80 billion for ports and $120 billion for airports and $63 billion for railways, et cetera. So I think there is a difference. I'm not saying that there's some huge inflection point here, but that there is gaining momentum that's there. The second point that I wanted to make is with everything that happened with the financial crisis and then the pandemic and the amount of financing that the U.S. government and, as Ben said, the South American governments have had to put behind public support, those public balance sheets are stretched like they've never been stretched before. And then the growth of the business that we're all in, raising larger and larger amounts of private capital from institutional wholesale investors and the like, is kind of a perfect setup to sort of for the government to listen to us in a way maybe that they haven't been listening to us before. So, Carl, you always have better numbers than I do, so I'll hand it over to you.
Yeah, I wouldn't characterise it as sort of there's a single event that means we've gone from X to Y or we're going to go to X to Y in 12 months' time. It's that direction of travel. Like the key things that have been driving the private capital opportunity have been in place for a number of years. They're going to continue, and then there's a number that are actually going to accelerate. So the key point is it's a bigger opportunity set. It's going to get bigger. There'll be some variation across sectors, but that direction of travel point is the critical one. And it's not like we were short opportunity. A couple of pieces of legislation passed, and now actually there's an opportunity that wasn't there before. Think of it as accelerating some areas. But honestly, without that, it still would have been a growing opportunity. It's just an even better opportunity now.
We'll go to Andre first and then John.
Good morning, Andre Sednik, Morgan Stanley. Can I ask two questions? The first one around the evolution of the Green Investment Group. So previously, it's basically deployed Macquarie's own balance sheet. Going forward, you want to bring in more external capital, but what kind of mix you're aiming for? Would you be still looking to invest 10-20% of Macquarie's own balance sheet and the rest with investor capital, external capital? And what kind of time frame will these new vehicles take?
Okay. So just to kind of level set, when you think about MAM, unlike say 5 years ago, you need to think about it as we're an integrated asset manager. And when we go to speak to clients, we talk about capabilities, not acronyms. Correct? You'll be surprised, clients love that sort of stuff. So rather than us talk about us in our language, we talk about it in the language that clients want. And those capabilities are obviously things like real assets, private credit, real estate, fixed income and equities. When we talk to them about real assets, it's really about raising funds that are focused on either infrastructure or things like energy transition, and so having strategies around that. And the Green Investment team are a team that is really executing and driving one of those capabilities, which is clearly in the green investments. So going forward from a MAM point of view, all our investing in the green space will be done through fiduciary vehicles. And so we're at the moment developing those strategies as we speak. And so from a Macquarie point of view, in terms of what the Green Investment Group has done traditionally and what MAM will do, we will have a GP stake in those particular strategies, but our investing will be done via those vehicles. And the reason for doing that is the opportunity set is so large and our pipeline is so large, we need to draw on responsibly third-party capital to do that from a Macquarie Group point of view. So that is prudent from a balance sheet point of view, but also we think we've got the skill set and track record to do a great job for clients, so it makes sense to have that as a fiduciary offering.
Thank you. My second question, I wanted to ask, on the public market side, you've given us a lot of information, but perhaps two of the key metrics we would generally use to evaluate public markets as managers which is basically the flows and the revenue margins. We haven't heard much about. So can you make any comments about what kind of flows you're seeing, particularly with Waddell & Reed integration, and then the margins, and again, how does Waddell & Reed shape the margins going forward?
So I think when we, at the last results, certainly at the end of last year, and then through some of the other results we've had, I think what we've been saying is, look, like the rest of the market, our flows have been down, our assets have been down. That they obviously move with the market. There are some good stories, particularly say in fixed income, where we've had positive net inflows. So that's been good. So I think from a flows point of view, we're generally comfortable with where we are at the moment. And similarly, clearly, our margins, if you look at it from an operating leverage point of view, are sort of where they have been traditionally. I don't know, Sean, whether you want to touch on anything more?
I think you hit the flows point well. I think on the margins point, we were expecting with the Waddell & Reed acquisition that we would see margin expansion of somewhere between 5 and 10 points for public investments. Probably given what's happened with the markets, to Ben's point, we're in kind of line with history, right? And then goes back to my point before, rising tide lifts all boats. As the market starts to stabilize and move back up on the equity beta side, you'll start to see that margin expansion come to realization.
John Mott from Barrenjoey. The Inflation Reduction Act, you talked about how it's transformational for the business, especially in areas like hydrogen. I've got a question. I've got to understand the political sensitivities here, but has that got bipartisan support in that when you look forward over years, decades ahead, often investments into certain areas which are relying on tax credits and other things tend to come under political pressure when budgets change, whether it's for defence or health or another area that becomes more politically sensitive. What's the viewpoint of both sides of Parliament for supporting this transition to green energy, and are these investments viable standalone without the tax credits?
Yeah, sure. So maybe I'll ask Will to talk to that, but a couple of things. I mean, when you're an infrastructure investor, in every investment you make, you're thinking about sovereign and regulatory risk, particularly where there may be some sort of tax exemption, credit, stimulant. So obviously every investment we make, we're thinking about that and pricing it in. That's the first thing. And we accept, just as we've talked about today, that the world is dynamic. Because you have a regime today doesn't mean you'll have a regime tomorrow. And that's particularly informs how we shape things like the capital structure in any investment we do. So I think, first of all, we're very alive to that. The second thing I'd say is, despite what you might read in the newspapers, irrespective of what state you go to, if you speak to clients in those states, most people are interested in diversifying their portfolios. They understand the future of energy transition and energy diversity, and they want to align capital with that. So I think our experience is much more muted than is probably being reported in various media outlets about people are just looking at energy transition as they would any investment thematic and working out what makes sense from a portfolio allocation point of view. On the sort of specifics of the support for IRA, maybe, Will, that might be something good for you to address.
I'll add to that. I think I'll just first remind folks that these are not new tax credits. They're new for certain technologies, but there have been tax credits for solar and wind for years, and that has been continuously renewed and extended. And so we have been through that cycle, and so we do have confidence that the system is resilient and will uphold these tax credits that have been around for a while. I think the other point to remember is that these tax credits are temporary. They're not legislated forever. So they will go away, and it'll be up to our legislation, our government, to decide whether or not we need to extend them further. So it kind of makes it a little difficult for opposition or really anyone to come and try to unwind it, because it's the political pressures are not, it's much harder to actually unwind these credits versus sort of working with them and then talking about a renewal down the road.
Brian Johnson, Jefferies, and a shareholder.
Thank you.
And happy shareholder. Ben, I had two questions. The first one is, if we're to go back to 2008, I can remember sitting thinking the listed infrastructure business, 2006, 2007, the listed infrastructure business was absolutely fantastic. But in retrospect, what we saw Macquarie do, basically a little bit of ill discipline, everything became infrastructure, and it all worked because it was a really kind of easy market. If we go back to this, rising boats analogy, from 2008 to 2022, even I could make money investing because bond rates were always kind of going the right way. Can you just run us through or explain to us why we can be confident that the discipline is there in a world where we see all your competitors moving into the space, everyone's saying the same kind of thing? Can you just give us some confidence about that discipline on the underlying value? And then I had a second one.
Well, I hope I can, Brian. Yes, that's my job, right? Look, I suppose that's a great question. Why are we going to keep being successful? Why does a winning team, and it's easy to win once or twice, build a culture and a history of winning? That's the hardest thing for any team to do. And I think it's first of all is that you've got to invest and build in having something having a business that stands for something. And it comes back to my point about having an important job. We've never led, any of us, a more multi-generational workforce than we do today. Our workforce has never been more diverse, and increasingly that workforce is younger and younger. And when you spend time with that workforce, why are they joining a business? Because they want to do things that make a difference. And what we do makes a difference, right? Hundreds of millions of people every day rely on us to run their businesses, to get to work, to heat or cool their homes, to get their kids to school. That's important. That's benefiting communities because we're employing people and driving economic inclusion and empowerment. We're doing it in a way that is good for the environment, and ultimately we're also delivering returns for everyday people who need it for their retirement and their insurance policies. So, like all of Macquarie, we have a real purpose, and what we're doing is important. And we've got a leadership team and teams underneath them that have, continuity, who have expertise, and who have the right level of passion. They're good people, and good people drive good teams and they make good decisions. But I'll give you one practical example. The vast majority of investments we do don't come from competitive processes. They come from our teams working their networks and out and about their environments, identifying thematics that make sense for this particular market, and there is always nuance to that, right? So we don't want to be just in the right neighbourhood. We want to find the right house in the right street where we can add value to that house and where our neighbours will appreciate our ownership. So everyone says they're a thematic investor, of course they are, but we have a level of precision and focus that allows us to find not just the right neighbourhoods but the right houses. But also the way we're able to surface those opportunities is normally done in a bilateral relationship. That allows us to buy better. But why is it that we're able to do that? And it comes down to really one thing and one thing only. We're trusted by those stakeholders. People know that we have the capital, that we'll get the debt, and we'll be able to get the support of the management teams and the broader teams that work at those businesses to be the owner of that business. They know that we'll get the regulatory approvals. They know that we'll act efficiently and effectively. And they also know that they've been doing business often with us many times before, that there'll be opportunities in the future for us to do business with them again. And that's why I think we're able to be successful in these in the different focus areas in MAM, is that we're not trying to be all things to all people. We have 4 or 5 capabilities that clients know us for. They meet the same people, they build a relationship with those people, and then they see the performance and they appreciate who they're doing business with. Now, Graham stole a quote that I emailed to everyone before in his presentation. Thought that he would get away with it. Shocking to me, to be honest, anyway. Which is a great quote, I think, by Hamilton, given that we're in Philadelphia, which is all about this idea that if you stand for nothing, you fail for everything. And I think if you go back through the 50-something history of Macquarie, we've actually always stood for something. Maybe we weren't as good as explicitly boiling that down into a purpose statement or a vision statement, but we've always stood for for being like a positive contributor in the communities in which we operate. We haven't always been perfect, and we have made some mistakes along the way, as you've highlighted, but the essence of who this business was 53 years ago is still the essence today, and that permeates all our teams. It permeates Alex's team, it permeates Nick's team, it permeates Michael's team, permeates our team, which is all about actually understanding what our responsibilities are and going and executing that and remembering that people are relying on us. And so if people think they can rely on you and they can trust you, that's the essence of, I think, a really good business that is sustainable and can keep winning.
Then a second question, if I may.
Sure.
Having caught up recently with one of your competitors who said their next vintage of one of their funds was going to be smaller. If we go back and we have a look at Supercore 2, which was a monster, can you just give us a feeling on the evolution of the size of basically the vintages here in the US, the fees, both the base fee and the performance fee, and basically the initial co-investment?
Yeah, sure. So all our, I suppose, vintages in the marketplace, over most recent times have all been record fundraisers for those particular vintages. It's hard for us to look forward and ascertain whether, because of the changing economic environment and some caution creeping into some investors, the next vintages will be smaller. I don't know, but we're very happy with the track record as each fund has stepped up. So I think that's fairly instructive. In terms of the fees, I think since 2017, we've pretty much guided everyone to the fact that performance fees of EUM are running at sort of 50 bips, and base fees are running about 90 bips. And for all our sort of infrastructure funds, if you like, that remains consistent. We are raising some new fund types from an innovation point of view that are funds that are longer dated. Some of them are evergreen funds, so we have fee streams for longer, but in those cases, and say in the cases of private credit, as we raise more capital there, clearly they attract different sorts of fees and lower fees to the classic infrastructure private equity funds. And as it relates to those funds, which are obviously a huge part of our EUM, the sort of fee guidance that Alex has shared many times, remains consistent. So I think that was the answer. So size, fees, and what was the third one? Yeah, so look, we continue to, this is a pretty, asset-light business from a Macquarie point of view, so no real change there. But we continue to support our funds, with meaningful amounts of balance sheet, but not, particularly different from what we have done historically. That's very well received by our clients, and so we'll continue to do that, both because we think it makes sense for shareholders, but also it creates great alignment with our clients.
So we're getting the wrap up, so I'm going to disappoint a couple of you. We'll come back later. So Brendan, maybe just one last question.
Thank you, Brendan Sprouse from Citi. I've just got a couple of questions on your wholesale or your wealth strategy. What sort of metrics should we be looking at in 3 to 5 years' time to see the success of this strategy?
Yeah, I think the answer will be how much AUM we're getting from that particular channel, number one. And that will also be about the diversity of AUM we're getting from that channel. So if you think about the wholesale channel today, particularly say here in the US, that's fundamentally important to our public investments business, and you've seen about half of our capital is getting, for that business, is coming from that particular channel. What we want to now do is take that channel and put products from other parts of the business down there, or distribute them through that channel. And so I think that will be the metric in sort of 3 to 5 years, is what's, say, the diversity of channels that we're growing our AUM for other products other than just in Sean's business. That's what I'll be looking at, and that's certainly the metrics we'll be judging ourselves on. I don't know if Andrea is here. Oh, Andrea, anything else you wanted to add to that? No, I think that's okay, great.
And just a second question. Often taking institutional product and putting it into the wholesale space requires quite different liquidity requirements. You've had to support funds that you've had listed. Other organisations have seen equity funds trade below net asset value. Yeah. I mean, how much balance sheet do you think you'll need to support this growth, to support the liquidity of these products?
Yeah, sure. Graham, do you want to talk to that?
Yeah, there's a really interesting quote that our colleagues from Central Park Group said to me through the acquisition, which is, if you don't talk about liquidity to retail investors, they don't ask for it. And the essence of that is really something important to think about. If we do offer those open-ended products, and you've seen the NABs move, yes, the issues all around liquidity and how investors are seeing that. But there's a whole host of closed-ended products that high net wealth investors have been taking for many, many years. And the experience is when you're marketing and selling those funds, you don't talk about liquidity. Investors don't expect it. And so I think that's the nuance to the whole opportunity, which is they don't all have to be those open-ended, mark-to-market, NAB-based funds offering periodic liquidity.
The other thing I'd add to that, and that was a good answer, Graham, was we already have funds today that have liquidity measures. So it's not something that we haven't done before. The second thing I'd say, and probably specific answer to your question, is it's not going to require any material amounts of balance sheet. So we're actually very comfortable with both having the skill set to do it today, understanding what clients want, but also it won't in any way impose any material needs on the balance sheet. So we've structured the business in that way for that very reason.
Right. Thanks. So Kieran, Ed and Nick, I'll get you first tomorrow. We're going to do a quick office tour, unless you had any other comments to make.
I don't have any other comments to make other than we've got Andrew Burdick here, who's actually going to introduce the office and talk a little bit about the design both here and I think then tomorrow again in New York. So I'll hand over to Andrew. Thanks everyone for your time today.
Thanks, Ben. Thanks you all for having me today. Good afternoon. As I said, my name is Andrew Burdick. I'm an architect and I joined Macquarie about 4.5 years ago as our global design director. So I'm based in New York and I collaborate with all of our businesses as well as a number of internal and external consultant teams to develop our workplace strategies as well as our designs for our workplaces as we grow around the globe. So really proud and excited to have you guys here at 100 Independence. As Sam mentioned, we're going to do a short tour talking around 3 or 4 key design drivers, the things that really drove the development of this facility. It was an interesting one because it straddled COVID. Design before, moving in after, and there's a number of key lessons learned from that I think might be really interesting to you all. We'll talk about it as we walk throughout the facility, as well as take any questions that you guys have. Now we are a pretty large group today. So we'll primarily utilize the stair to move between floors. If anybody would prefer to utilize the elevator, Ellen at the back there, can you raise your hand? She'll be posted at the elevator lobby on each floor, and we're more than happy to make sure that you guys can move between floors with us on the tour. One last point, I think most people check their coats. We will briefly have an opportunity to go on the roof. It's gorgeous today. Our resident hawk seems to be flying around out there as well. So we will stop out there briefly, but it is still a bit brisk, so we won't really do much talking out there. We'll just take a few photos if you want and come back down. If you join me out at the base of the stair there on level 7, we're going to walk up to 9 to start, and then we'll take a few stops through the building. Thanks.